This conference, we're really excited to be back, obviously, after a few years of a hiatus. I mentioned that this morning. But Chuck is truly integral to this coming together, sitting next to Joe from K-State. These guys work together in respective teams to put the next 24 hours together in a smooth, efficient way, which you'll see. Great speakers and a lot of really interesting topics to discuss and engage with all of you. So I do just want to give Chuck a special shout out for all the work he's doing and has done, in addition to his day job as well. So with that, good afternoon, and again, welcome back to AgCon. Traveling to Kansas City, leaving Washington, engaging in person, listening, answering the hard questions, working toward finding solutions for America's farmers and ranchers. This has always been my number one priority, and I couldn't be prouder to lead the return of this conference in nearly 4 years. In 2019, I closed this conference with remarks filled with gratitude for the relationships that flourish within the ag commodity space and the commitments we all make to share our side of the story as we work within the agricultural risk management ecosystem towards safe, reliable, resilient, and accessible markets. At the time, none of us could have known that our third conference would be so far off, or that a perfect storm of externalities would impact commodity markets so profoundly in the interim. Futures markets played a critical role during this extraordinary era. With livestock and grain markets under historically intense stress, futures market transactions continue to be a reliable, transparent venue for price discovery and hedging for some agricultural markets. Tremendous uncertainty from the supply chain breakdowns during this unprecedented time manifested in futures bid-ask spreads widening significantly, historic price volatility, and futures price limits being triggered at the highest rate in history in ag markets like lumber and livestock as well. Even as the world was recovering from the effects of COVID-19, commodity markets, especially ag and energy markets, faced tremendous challenges brought on by Russia's invasion of Ukraine. Today, geopolitical risks, extreme weather, supply chain constraints, changing global trade patterns continue to affect our markets to some degree. Through all of this, the futures markets have continued to function well, reflecting supply and demand fundamentals and providing a venue for risk management and price discovery. But the U.S. derivatives markets are not only vital to agricultural stakeholders for price discovery and hedging. The information and data generated and disseminated by and through our markets underpin many more USDA-sponsored risk management programs, such as insurance and commodity-based programs. Through the CFTC's role is limited in cash markets to enforcement authority, CFTC economists and analysts monitor the commodity markets on a daily, real-time basis and can view the derivatives positions of large traders on a next-day basis. CFTC regulations require, and CFTC has access to extensive data beyond large trader positions, including transaction, messaging, and swaps data. Evidence of CFTC's rigorous surveillance and monitoring work can be seen in the number of enforcement actions related to ag and livestock markets over the past few years, from misreporting to manipulative activities, including spoofing and misconduct involving confidential information. Bringing bad actors to justice not only maintains the integrity of our markets, but our enforcement orders provide transparency by helping to identify potential structural market weaknesses and clearly articulating when conduct may cross the line. Another way the CFTC promotes transparency is by publishing weekly commitment of traders reports, and we launched a new user-friendly platform in 2022. We share a common goal in ensuring that strategies employed today will support and sustain the ag markets in the decades to come. These strategies include making certain that our derivatives markets remain resilient, accessible, and cost-effective as a risk management and price discovery tool. They also include safeguarding the cash and futures markets against mischief and misconduct through robust surveillance and swift enforcement. And we must ensure that as we increasingly incorporate new technologies into our operations, we do it responsibly. With a vibrant and robust market with diverse traders, active regulatory oversight, and strong enforcement, we can proudly and safely say that the U.S. futures markets are the benchmark for global trade and price setting. I want to thank all of those who have made AgCon 2024 possible, from K-State And I'd also like to recognize Joe Parcell, Director, and Emily Garwood, Managing Director of the Center for Risk Management, Education, and Research. From the CFTC in Kansas State, I'd also like to thank our moderators that you're going to hear from over the next 24 hours, Tom Smith, Ann Wright, Rob Schwartz, Lonnie Hobbs, Brian Coffey, Nathan Hendricks, and Ted Schroeder. I wish to extend a collective thank you to all of our panelists and extend a warm welcome to our special guests, Ambassador Doug McCaleb, U.S. Senator Roger Marshall, and Jeffrey Schmid, President of the Federal Reserve Bank of Kansas City, who we'll hear from tomorrow afternoon. And most importantly, I want to acknowledge that putting together a conference like AdCon takes a tremendous amount of work. As I said, I want to thank all of the individuals who put together this event, from procurement to legal to our travel and business managers and our own press office. In particular, Chuck Marvin, thank you for all of your efforts. Putting this together is a full-time job. And as I said, Chuck has handled it with enthusiasm and good humor. And now, after tomorrow afternoon, he can go back to his other two full-time jobs, both being the Kansas City Regional Office Director and Deputy Director in our Division of Enforcement. The CFTC's return to Kansas and our partnership with K-State Center for Risk Management, Education, and Research has endured because we understand that the folks in Washington benefit from firsthand experience of engaging with farmers, ranchers, and commercial end users in the ag complex to learn and better understand what is happening and how your experiences are impacting the larger economy. Only then can we represent your interests and ensure that we make changes that will improve the market meaningfully. A healthy farm economy is a big part of a strong and vibrant rural economy, which is integral to our nation's prosperity. More broadly, conferences like this one provide opportunities to dig deeper into the issues that may not be making the headlines, but assuredly impact markets and stakeholders in significant ways. The first AdCon in 2018 focused on consumer awareness and customer education. In 2019, we focused more on issues of market integrity, questions like the impact of matching algorithms on market performance, and the convergence of futures and physical prices of grain and oilseed. Price discovery and liquidity are integral to well-functioning futures markets, and the CFTC must ensure that market structure does not adversely affect either. These conversations serve multiple important purposes. For the CFTC, they enable us to better serve our constituents. But these conversations also provide for awareness that hopefully builds confidence in our markets. Like the markets themselves, these conversations reduce uncertainty and risk. We were off to a solid cadence when the pandemic forced us into hiatus. Returning for our third AdCon 5 years later, our agenda aims to level set our knowledge base for newcomers and explore the developments in agricultural derivatives and larger financial markets that present the greatest challenges and opportunities right now. Our agenda kicks off with an issue that has been making the headlines in our space, the evolving relationship between futures commission merchants and customers, and the potential impacts of new regulation on the clearing ecosystem. I recently testified regarding proposed rules by the prudential bank regulators known as the Basel III Endgame and GSIP surcharge proposals. A paramount concern raised by market participants is that these proposals could reduce banks' ability to offer hedging services to clients such as farmers, ranchers, and other commercial end users. The CFTC has been closely monitoring these proposals, and in addition to personally engaging former colleagues from the prudential regulators and market regulators, we have put together a team of experts at the Commission to work alongside our regulatory counterparts. Our aim is to educate, identify what we are seeing in our markets, the changes that have occurred, the concentration of participants, the reduction of services for small participants, and the importance of the diversity of participants so that producers can have access to futures markets. During my testimony, I shared some important data points that really drive home the issues. Going back to 2004, there were 177 CFTC registered FCMs. Right now, 20 years later, we have just about 64, a huge reduction. At the same time, we have seen an increase in customer funds held by FCMs from approximately $80 billion in 2004 to about $500 billion today. In short, we have had tremendous market growth and a reduction, or perhaps more aptly, a concentration in capacity. This is even more striking given that the 5 largest clearing members, all banks, hold about 60% of customer funds. Our role is to share our perspective and expertise on how the derivatives markets address risk, the role of capital within existing frameworks. There's always a tendency to evaluate similar activities as presenting the same risks, but that's not the case in our jurisdictional market, as there are active and dynamic mechanisms such as margin, to name just one, that provide real-time position and customer management. CFTC staff are engaged, and the prudential regulators have been receptive to understanding our view. To be clear, capital is one of the benchmarks and foundations of good financial regulation. It is important that prudential regulators move forward with the Basel III Endgame and G-SIB surcharge. We certainly and painfully are aware of what happened in 2008 when firms were so undercapitalized, yet required a government intervention to keep the economy afloat. But I believe we should be mindful about how it is implemented. We have to preserve incentives for clearing and ensure that market participants are not cost prohibited from pursuing effective risk management. As we think about policy going forward, we must be intentional in our efforts to understand the trend of disappearing FCMs over the last 20 years and the impacts it's having across markets. While we have witnessed consolidation like this across many industries, the derivatives markets require a level of diversity that requires a balance of participants to avoid concentration that could ultimately lead to cascading consequences that bleed into the larger financial ecosystem in the event of a participant failure. Moving forward, later this afternoon, my fellow commissioners, and thanks to all of them for being here, will gather for a panel focused on their views of the issues important to the agricultural community. They will be followed by another unique panel focused on illegal conduct in the cash commodity markets and how the CFTC uses its authority to deter and stop both fraud and manipulation, sometimes alongside the Department of Justice, who can bring criminal actions. We will close the day with remarks, as Chuck mentioned, with a fireside chat and short prepared remarks by our honored guest, Ambassador Doug McCaleb. Tomorrow morning, Senator Marshall, a member of the U.S. Senate Committee on Agriculture, Nutrition, and Forestry, will start our day with opening remarks and a transition into day two, which will focus on learning on the life cycle of a futures contract. And I promise by 9:30 you'll be certainly in the know regarding the who, what, where, and why of our underlying markets. We will transition quickly into the new frontiers of data and information with a diverse group of experts who will walk through a behind-the-scenes tour of decision-making when it comes to market data and information, and a panel on voluntary carbon markets. Jeffrey Schmidt, one of our newest Federal Reserve Bank presidents, will join us for a lunchtime keynote with an impressive work history and perspective on bank regulation from his earliest days as an FDIC field examiner in its KC office. I'm sure President Schmidt will bring a unique perspective. Not entirely sure what's going to be served for lunch tomorrow, but be forewarned that is followed by our final panel on hot topics in livestock. So for the CFTC, the purpose of our conferences and committee meetings, first and foremost, as I said, is to listen, learn, and lay out what we can each be doing to support the ag economy. And I understand there are a lot of challenges, a lot of unknown issues and risks these days. The ag economy has faced stiff headwinds for many years. Persistently volatile commodity prices, extreme weather events resulting from climate change, and trade policy are just a few of the significant hurdles that make production agriculture more challenging every year. These are uncertain times, and the whole purpose of our futures markets is to help provide certainty. I believe the strength and vibrancy of the futures market, which serves as a critical price discovery and risk management tool for end users, is a testament to the creative and entrepreneurial spirit of the American farmer. Last year, I testified before the Senate Committee on Agriculture. At the time, the process for the 2023 Farm Bill was underway, and your concerns and expectations were front and center. With ag market developments at the heart of policy debates on a global scale due to increasing food prices, transportation challenges, climate change, ongoing market volatility, market concentration, and the real risk of food insecurity, I reaffirmed a commitment I made during my 2017 nomination hearing to ensure the U.S. derivatives market remained both a desirable and cost-effective risk management and price discovery tool for agricultural producers and the entire value chain. The lack of certainty in your business is in part why the derivatives markets exist. As Farm Bill negotiations continue, the Commission is watching them closely, and I will continue to advocate and voice my support and leverage our relationships to ensure that information flows and dialogues continue. In closing, I want to thank again our friends and colleagues at K-State for collaborating and joining us in this effort. I want to thank all of you for being back here with us today. We are extremely excited about the next 24 hours and the discussion we're going to have. We look forward to your engagement, your questions, your inquiries. We want to be here as a resource to help answer problems and find solutions so that we can continue to have a robust and very strong ag economy in the United States. Thank you very much.
One thing I did neglect to state that if you have any questions, you can scan the code and I'll get them up here. So I think we might have a microphone available as well. If you want to just do that early. Matt, anything to add on this?
Again, my name is Matt Heitkamp. I'm with R.G. O'Brien. I'm probably a little bit different than most of my colleagues in that I've spent all 30 years with R.G. O'Brien. We've always been a leader in the ag space, so we've seen a lot of the changes, experienced a lot of the changes. Some have been good, some have been tough, but you know, they are what they are. You know, when we look back over the last 20 years, I mean, we were still coming off the floor mentality, and at that point, the risk management was a $20,000 phone clerk asking the desk manager, "Is this guy okay to trade this much?" Right? And you know, now it's you know, much more about you know, the risk management policies that we have in place. You know, are constantly looking at clients' balance to see if they can trade, are constantly being reviewed. You know, run through standard deviations to see where our true risk as a firm is at. And it's just interesting to see the landscape that's changed. You know, when we started out, we had firms like PFG and that you mentioned, and Aileron and Refco and Iowa Grain, and none of those firms are around anymore. So the consolidation has certainly been big from an FCM standpoint, which you had touched on before. You know, we are starting to see a few players coming in to the game there, but the number of FCMs is definitely a concern, especially as it relates to Basel III. As a privately held FCM, that doesn't really affect us. Some of the bigger challenges that we see coming forward are the changing methodology for margins, and as that gets rolled out through the industry, SPAN 2 is what it's referred to from the CME, but that's not much different than many of the other exchanges and their methodology for looking at margins. For the ag community, it rolls out in 2025, but you know, people that are used to having a set margin value that stays in place, it's certainly going to be a challenge for end users to get used to that and make sure that they're covered from that perspective.
And Ed, from an end user perspective?
Yeah. So the idea of capacity, you know, predates Basel, and I think if you look at where we came from, I appreciated the chairman's remarks of from 120 to 60 in those years. We had raised an issue from the end users as capacity and access long before we thought about changing bank regulations. You know, from the end user's perspective, we don't go to the derivative market to acquire risk. We go to the derivative market to offset risk. It's one of the few places that we really don't have a choice of where we go. There's one price discovery mechanism, and that's our vehicle to take risk off our books. Today, that capacity has to be built from an end user's perspective. We trade bushels, but the exchange turns that into risk dollars. And obviously that risk dollars makes a lot of difference between the day after Russia came over the Ukraine border or a normal day like today's Thursday. And we have to have the capacity to be able to hedge these products, whether they're in risky times or not. And I think that's a real concern from our perspective. The banking regulation changes just heighten all of that. I point out that long before we heard about banking regulation changes, we lost Wells Fargo, which in the ag space is a big deal. A systemically important bank. There's a lot of my peers that are required to use FCMs that have banks as FCMs. And we continue to lose options. The lost options, I think, from the end user community, first of all, we think about cost as the demand goes up, and the demand has gone up, most notably because we decided that through Dodd-Frank that cleared was better than not cleared. And that was an appropriate decision, quite frankly, but we've got more demand and we continue to have less supply. And the bid-ask spread's going to widen. And for all of the reasons around regulatory peril, as well as simply that there's not as many places. I remember the grand old days before MF Global, you could be a single FCM shop. There's not a risk officer in the world that would let you be a single FCM shop today, because we saw the participants that couldn't access their funds for more than a day. So all of that kind of comes to a point where we had a problem that we were trying to raise before the bank regulations. And now with the bank regulations, I think it certainly brings it more of a concern. I didn't know that the end users would ever really have a problem with banking regulations. It's not really something that we pay as much attention to, but the unintended consequences of them trying to make the system safer, which we certainly are for, but the unintended consequences this time, I think, is going to continue to exasperate a situation that was going to need some attention anyway. I can speak from Schooler's perspective, and I think I echo most of the end users. We have no interest in a disintermediated model. The clearinghouse should be sacrosanct, and all of those things that protect us. We need FCMs, but we're going to need an environment that's competitive enough for us to be effective hedgers, and then also have the system flexible enough to maintain the capacity needed for those events that will be sure to happen.
So Matt or Jeff, are we at a state where you're looking at clients or prospective customers coming in and making decisions as to whether you'll onboard them or not based on sort of capital and other issues?
Yeah, I mean, that's really, it used to be that, the clients kind of interviewed all of us and, they made their decision. And now I think that it's really the reverse paradigm where we're interviewing clients saying we need to see a sample portfolio, we need to run capital metrics on it, we need to know what your capital footprint is, do we have the capital available? Is margin from the exchange, is that sufficient to cover the exposures that we're seeing? The other thing that I would say to Ed's comment referring to the MF Global situation where funds were held up for a period of time because there was the funds were tied up at in the bankruptcy proceedings of MF Global. Under Basel III, those margin funds themselves become a leverage asset, which on its face runs in contradiction to what the core purpose of the CFTC rules are around segregation. The paradigm is not yield creation, the paradigm is asset protection. And the prevailing CFTC rules, CFTC 125 around permissible investments and what an FCM can do with those funds should on its face not necessitate that putting the funds on your balance sheet, yet here we are.
Yeah, I mean, we wouldn't say that we're not looking for more business. I mean, that's clear. But the hurdles that clients have to meet to make sure that it's makes sense for us as well as for them are certainly higher than they were before. We're probably a little bit different because we're not a bank, so we have to look at things a little bit differently. I don't know that the changes will affect us as much as it will the bank FCMs, but you know, to every FCM is going to have their own way of looking at it, and to the end user perspective, that could be quite a difference in what price and what options that they have available to them.
Right.
Unfortunately, that burden is going to land on those least able to deal with it. The big firms will find clearing. Middle-sized firms will find clearing. Smaller firms on our side are the ones that are going to lose access quickest.
Hold, can't find it.
Right, right.
I mean, in that simple ROE calculation, right, where you have the revenue over, for us, a very expansive denominator because of the size to which Basel has compelled us to calculate capital. You know, it's like throwing a snowball into a furnace to try and generate the amount of transactional volumes to pay down that denominator to make it make sense for a bank to allocate capital where you have multiple businesses, some of which are performing much better on that same dollar of capital.
Yeah. So that's the issue. If you're the type of trader where you're going to hold positions, not generate a lot of commission income for the FCM, it's going to be more challenging to get picked up, and it costs more potentially.
I would, you know, there's always a precedent. We're never doing this the first time. We should have had Tommy Hayden up here, but cotton in 2008, 2009, 2010, the cotton market got so extreme, the margining costs got so expensive that there were players that just quit hedging. They carted out cotton firms that had been there for over 100 years that ceased to exist because of that. So there are real world changes, or real world consequences rather, if this tips over. And I'm not here to suggest that we're anywhere close to that right now, but I do think that it's grand that we have a forum to talk about it before the crash.
Well, I mean, the EU, an even more recent example, the EU, look at the EU natural gas market from 2022, where you had gone from a price under $10 up to a peak of 350, and at one point the margins were covering over 80% of the notional value of that contract. Surely not how margins tended to work, and liquidity did suffer as a result of it. Number one. Number two, because the notional value of these contracts and the Basel rules compel you to calculate a gross notional value, what we were seeing across the space was that firms were implementing gross notional limits. So in order to control their balance sheet, they would say, you have to reduce the size of your nat gas position cleared with us as a consequence of these, not reflective of the risk, because at that price, you're covering 80% of the notional value. From a pure risk perspective, you're covered from the margin perspective, but from just the liquidity and access perspective, there was some serious constraints at that time that really put in danger the ability to price discover.
And Jeff, being a broker-dealer FCM, do you look at this a little bit differently in that a lot of times you're accommodating securities customers who need to hedge positions and use the futures part of the business? I mean, is the calculus a little bit different than it would be from Matt as a sort of a standalone FCM?
That's a great question. The immediate answer to it is not as a consequence to a BD, but having worked at a prime broker previously, that's what gets prioritized at those PB shops. Number one, they trade a lot of volumes, but they tend to take up a lot of the practice of the FCM that's embedded within a prime broker. That's certainly the priority. And going back to the supervisory factors assigned to the products, I mean, maybe a hedge fund trades, say 10% on average of its AUM in the commodity space. So overwhelmingly, you've got a small footprint of leverage exposure from those products in a hedge fund's portfolio relative to commodities. We because we don't have a prime broker, but we have a commercial bank that interfaces with a lot of commodity end users. That tends to be what the flow is. So the answer to the question is that the trends that have emerged is that you prioritize kind of your core business. So if you're doing banking business with us, then you have a better chance of being a client of the FCM as well, because we're trying to and expand our wallet with those clients.
Right. And Matt, your experience just as a standalone FCM, you're focused on that business and looking for the clients there. You don't have I'll call it the term, the benefit of having sort of securities clients or other types of businesses going through your firm.
No, we do try to get all kinds of business in here, right? Just so we can have a little bit more balanced portfolio. Not only are we just an FCM, but we end up being a client as well on all the markets we don't clear. Probably 20, 25 markets that we're not direct clearers of that we have to go use other FCMs to execute business on. So, we have to get creative to your point of if you're just a hedger and sitting on a position and rolling it, no one will take your business. I mean, we would find ourselves kind of in that position with the markets that we don't clear. So we have to get creative and get day trading volume in there to be able to make it affordable for our clients to access those markets.
Right. So given that the FCM's business model effectively is to take on customers, charge commissions, and then have the ability to use Rule 1.25 to gain some earnings off of the funds that they're holding. And on the other side, fully guarantee the performance of the customers to the clearinghouse and also put up their own money in the guarantee fund and then also be subject to potential assessment authority that the clearinghouse could have. I mean, it's a difficult business model. And like, what do we look at as potential solutions to that? Or is there any structure changes or anything else that is evident out there that would provide sort of an incentive for more entities to enter into the space? I mean, even in the recent past where we had higher interest rates, you haven't seen a lot of newcomers into the industry.
Yeah, it's a tricky question. I mean, ultimately, it comes down to capital, and I think that the question is much more difficult here at nearly 6% in interest rates, right? I mean, the cost of funding are just that much higher. There was a article recently in RiskNet about a study of the residual interest holdings, which across the street have declined. It's like, well, that's a cost because of the prevailing interest rates. So it's difficult to envision how we're situated today with the size of the denominator from a capital perspective, how that environment is attractive for newcomers. One trend that is, and Ed kind of touched on this a bit, is the potential for self-clearing of large clients who have enough scale to become themselves an exchange member. And in fact, in the last year, and I think this was in response to the Ukraine invasion and the resulting volatility from commodities and some of the notional caps introduced from clearing members, is that you did see two particular large end users become members of ICE Clear Europe in order to become more in control of their own ability to transact in these markets as opposed to being capped out by the clearing members. So, that is potential, but it is also, I think to Ed's point, it introduces a new dimension of risk through the default fund. So if a member is to default, you go through the waterfall resources, and now I, as an end user, have risk to potentially my competitor or someone who, and a risk that I have no oversight over. So it introduces a new dimension of risk that I don't think that many end users would be willing to take on. At least that's my understanding.
Okay. And one of the things I think that we observed with ION when we had the breach there, and there was impacts on certain FCMs and their ability to function fully. I mean, the firms themselves were impacted in various degrees depending on how much they relied on ION for back office and middle office services. But one of the benefits some customers had is they were clients of more than one FCM. And the FCM that was actually impacted was encouraging them to use their alternative FCM for some trading. Now, they'd lose the benefits of possibly margin, portfolio margining, et cetera, but it didn't impact their trading, and it was able to continue doing what they wanted to do. That's even harder now when you have this issue of smaller number of FCMs and FCMs looking more carefully at who they'll take on. I think, like Ed, that would be something that probably wouldn't be really feasible for certain agricultural entities.
Self-clearing, and we actually have, we've explored it a little bit at Schooler, and I was at a larger firm that we explored it there. The regulatory peril that it puts you at, the reporting requirements, we're a grain company, we're not set up for that. And it's not gonna be a solution. I mean, the very biggest ag companies might be able to do that, but that is not a solution for access to the market to the vast majority of end users.
Nick, you want to give NFA's perspective on any of this?
Sure. You know, just to give a little background about NFA, we are the industry-wide, regulator. We, regulate listed futures, over-the-counter derivatives, and off-exchange foreign currency contracts, also called Forex. And every aspect of our oversight is overseen by the CFTC. We work independently of the commission. However, we are subject to their oversight, and we work together with them, as strong partners in rulemaking for our rules, comment letters for any various rules that the commission is pondering, and new regulations as the industry needs it. And a lot of the areas that we cover, were briefly touched upon by Jeff. We go into FCMs. Our number one focus is customer protection and control of customer assets, whether they be in SEG, secured, or clear swap, depositories. That is one of the top priorities when we go and examine FCMs. And we have a very strong oversight program that actually involves, on a daily basis, confirming, 100% of the assets on deposit by the FCMs, both NFA and CME. CME is a DSRO for majority of FCMs out there, more the larger bank-affiliated FCMs. We are the DSRO for the non-clearing FCMs, more mid-tier size and retail focused, and some agricultural livestock focused FCMs. And over the last 20 years, there's been just, several changes. I think for the good, enhancements to customer protection, as Jeff said, an increase in compliance requirements. The annual CCO report is, one of the big ones out there. Having that CCO attest to compliance with all the applicable commission rules, NFA rules, the risk management program, have the firm document and, a framework for the various risks associated, in operating an FCM, whether it be segregation risk, capital risk, liquidity risk, having a firm document that and having a program for that, as well as the reporting requirements for that. A quarterly risk exposure report, that gets the FCM and the senior management of the FCM together to assess the risks faced by the FCM, any breaches of maybe risk tolerances during that quarter, and then report that to us and to the commission, or at least provide a copy of that, that assessment. From a NFA rule perspective, the last 20 years, there's been several large ones, mostly born from just the various changes in the industry. One that comes to mind is, you just mentioned ION, the due diligence and supervision over third-party service providers, those vendors that the FCMs deem critical, or they're outsourcing various regulatory functions to, a supervision rule to have the FCM have a program regarding the onboarding, the offboarding, determination, and the record keeping of that vendor. Another big one that's out there and an ever-growing threat is cybersecurity. So having FCMs develop and create policies and procedures regarding their information technology, the risks associated with that, the controls in place to mitigate those, and an assessment of both the internal and external, cyber threats that they deal with. Those are some of the more critical ones I think that's, come out in the last couple of years from NFA alone.
And I think it's worth emphasizing a little bit the 2013 customer protection rulemaking, because that was a substantial change in the structure of the oversight and the operations of FCMs. I mean, we went from a state of FCMs always having their own proprietary money in segregation to meet customer obligations, but now it became a requirement to develop a methodology that you can demonstrate was reasonable based on your experience with your customers, the types of customers you have, your experience with customers failing to meet margin and ultimately defaulting, so that you always had sort of a basis for how much you were actually holding as your targeted residual interest. And another substantial change at that point in time was the requirement that the FCMs are obligated to put their own money into segregation to cover an under-margined customer. It has to be done for cleared swaps by the time of settlement the next day, and by 6 p.m. for futures and foreign futures of the next business day. That again, all designed to provide additional customer protection to ensure one customer's funds are not used to margin secure and guarantee other customers' positions, but it also factored into the amount of money that FCMs need, the proprietary money, to put into their accounts to cover for that eventuality or possibility. So that was, again, I think it was a very helpful thing to address the types of situations we had with MF Global and Peregrine. And I think Nick's point of the daily confirmation process that NFA goes through is really central to our oversight, in the sense that every day the FCMs are filing daily segregation records with NFA and with CME, and every depository that they use is reporting balances as of end of day. So each day, those all automated, but they're matched up, and you're able to identify potential shortfalls more quickly and question firms, and again, all designed for greater customer protection. So those have been the positive developments out of that rulemaking, and along with many others. The other one being probably the last one I'll mention is the LSOC, where we have in the cleared swap space that the clearing organization is entitled to look only to the account of the defaulting customer that's presented by the FCM, not the full amount of funds on deposit that the FCM has with the clearing organization. So that's a fundamental shift. It's only for cleared swaps at this point in time, and I think it's something that was talked about in the future space, but hasn't really been raised as far as I know in recently.
Yeah, no, available in Europe, individual seg, not permissible under our rules because of the prevailing bankruptcy code and Commodity Exchange Act. But, to my understanding, not many clients avail themselves of individual segregation in Europe. It is generally more expensive to handle, just because the basic structure of how an FCM operates is an omnibus account, the exchange, so you're processing a lot of transactions at once through one of these pieces of software. ION was mentioned. GMI is the overwhelming piece of software that's used on the street for processing futures.
Okay. Yeah, that's a good point to note that, if there is an FCM insolvency, there's a special provision of the bankruptcy code that deals with commodity broker liquidations. They must be a liquidation. There's no reorganization. So they're liquidated under this code provision. And to the extent that there isn't sufficient assets to cover all the obligations to customers, they share on a pro rata distribution. That would prevent us from having sort of this separate segregation without some type of congressional change.
But gross margin at the CCP went a long way, I think, to enhance the or solve the John Corzine problem in terms of the deficiency in the seg pool that was created there. So I think that to your earlier question about what it'll take for a new entrant to the space. There was long been the trend that clients favored bank-affiliated FCMs because not only were you dealing with a entity that had more capital in that direct entity, but you're also backed by, in our case, a multi-trillion-dollar banking organization. So if there is a client default, the availability of funds to cure that before engaging in this bankruptcy process is significantly less. With enhanced customer protection, that has been, I think, resolved to a great degree because the funds are all held at the CCP itself. So in the event of a default, if there's some, and I guess that's the natural next question, right? It's like if there's somewhere to port it to,
Right.
the funds and the positions are at the CCP.
Right.
But in this environment, it's a big if.
Right. And that's sort of one of the first things we would look at if there ever was a concern about an FCM, is we would get their daily records and look at segregation and say, how much of their customer funds is actually being held by a DCO? Because we know that funds are there and that they're not going to be released back to the FCM if we ever had a crisis. But fortunately, that's few and far between. We like to keep it that way through just regular oversight and the process we have with the DSROs. So we do that. If we'll talk just maybe briefly, because the chairman mentioned sort of the Basel III endgame and all of that the commission's doing, but I think what you just mentioned, Jeff, is the main thing that we're focused on is what impact could this have on a bankruptcy? What impact could this have generally on clearing? We want to support clearing, obviously, but the question becomes, if there aren't enough FCMs, how will you deal with the potential need to port a large default that happens? And that's critical for us for the efficient operation of the markets. Is, when we had Lehman Brothers fail, for instance, because segregation was fully intact, they were able over a weekend to transfer all customers to Barclays. And they were able to trade, and it was pretty much a seamless transaction. If they decided that that's not where they wanted to keep their account, they were able to move it somewhere else. But initially, at least, they were able to transact. You have a situation like MF Global or Peregrine or something else where you have to actually move the customers. That's the ideal thing, is you don't want the customers to have to break their hedges or do anything else, liquidate their positions. They want to keep their risk management on, but that means they may have to post additional margin collateral. So that's really what we're looking at as one of the issues with Basel, is what impact that might have on the ability or desire for some of those firms to stay in the clearing business. And that where it may have an indirect impact on you, because you may be in a situation where you might have to look at the situation of taking other customers on because there aren't as many players in the industry.
Absolutely, and
then the cost involved with
the
that.
cost involved, to back to Ed's point, rolls downhill, right?
It rolls downhill.
It ends up being more expensive for the
Your
end user.
capital requirement goes up from the CFTC because you've got more risk margin now on the customer positions. Harder to get customers to into the firm, so they have to pay more potentially.
I would just point out from the end user perspective too, we don't keep those costs.
Right.
We push them back towards the farmer or push them back toward the consumer. And unfortunately, in that tug of war, most often the farmer loses.
Not a good answer. No, not a good situation. The answer is fine. The situation is not good. I should correct myself.
Even Jeff had mentioned that there are some new players and new clearers in here. We're seeing some of the new clearers out there are the ones that go for that cheap day trading volume, right? So that volume is now leaving FCMs, going into the new players into the arena, which leaves the more expensive businesses to the remaining FCMs that are in existence now too. So that's another factor that goes into the cost.
An additional sort of new issue that's coming up is customer funding of accounts. We didn't talk about this in advance, but I'll just put it out there now. Like, we're getting a lot of questions on, can I use debit cards to fund my accounts? And I think this is something we're seeing more at the smaller types of FCMs. But traditionally, people pay by wire transfer, checks. They're probably less frequent. And there has been some ACH, the division of my predecessor division of DSIO issued a interpretation back in 2014, I think, talking about the use of ACH, which was really aimed at the ag community to allow them to set up an arrangement with their FCM where they authorize the FCM to initiate draws on their account that would be done through ACH on an overnight basis. And as long as that system was set up, they could recognize receipt of the money at the FCM upon the withdrawal or initiation of the ACH withdrawal from that customer's account without waiting to actually have it in hand. That helped with such things as that I mentioned about residual interest and and having the funds to cover under-margined accounts. But now we're seeing a shift or a request for more types of ways to process payments of customers, including Apple Pay, Venmo, and other types of things, debit cards, and ACH transactions where the funds may sit at some type of processor for a period of time, up to 5 days, because the FCM wants to make sure that the money isn't clawed back by the customer before allowing them to trade. The question in my mind is sort of twofold, and then I'll see if you have any reactions. You know, I look at it from the receipt of the money question is, in my mind, in order to credit the customer's account, to actually say you have it in your account, you have to have possession of the money. It can't be an in-process transaction. And secondly, from the customer side of paying the money, what we're looking at is, when are those funds in segregation? If I go onto the FCM's website and they have an application set up where I can enter my data and say, I'm initiating a transfer as an ACH from my account at my bank to the FCM, when they hit enter, do they think that money is immediately going to the FCM? Is it in segregation? Or is it in reality going to a third-party processing agent where it's held in a commingled account, and there's a fear that if something ever happens at that third-party processor, the funds aren't protected, because the funds aren't at the FCM anyway yet. So that's sort of the type of question that's just coming up with us. We're seeing it more and more through our DSROs, through the examination process. I think we've given some sort of, I wouldn't call it guidance, just sort of say what the commission has said already about this point by looking at the checks and ACHs. But I think it's an issue that's going to go more and more. I know I'm one of the few people that still walks around with a little bit of cash in my pocket. I'm not technology. Technology is not my thing. I go to the store with my son. He just pops his phone on the reader and he gets charged to his account. So we have more and more people, or I should say more and more people, but we have a greater interest in looking at these, I'll call them alternative mechanisms to finance their accounts. I don't know if you have any policies yet at your organizations on this.
I mean, we support ACH payments and direct wiring. We have not gone into the Apple Pay or those areas yet.
No Venmo.
Yeah, and I'm going to guess that the banks.
Yeah, we don't do any retail business, so that those are not considered. We're trying to go the opposite direction of getting funds quicker rather than you know, waiting for them. I mean, I don't know if anybody is here from the CMER or any of the exchanges, but you know, they take the money first thing in the morning and they don't even say thank you. So you know, before we even issue margin calls, the money's already out of the bank. So you know, for us to get those funds in-house quickly and confirm receipt of them in volatile markets is of paramount importance.
I'll see. Right now, I don't have, there are no questions on the slides here, but if anyone has any questions in the audience, I'd be happy to take them. Okay. As I said, I'm not technology, it's not my thing, but I don't see any on up. There is a question that has come in. Ed, you mentioned that there is no interest in disintermediated model for agricultural commodities. Are you afraid it will happen anyway?
Am I afraid it'll happen anyway?
Anyway, yeah.
I feel that we dodged a bullet with kind of the blow up of FTX, and it went on the back burner. I will tell you that the industry organizations that we are a part of and the peers that I network with were mounting a vehement argument for not going down that path, and that effort really kind of disengaged after the conversation went away. If it were to, for whatever reason, reappear, I think the end user community would not have changed their mind in any way, shape, or form that that would leave us much more vulnerable than we are today. It would make the clearinghouse less safe, and as end users, I don't think we have any interest in doing that.
Yeah, I mean, it will significantly change the risk paradigm for the exchanges, right? The exchanges, they do counterparty risk, but it's to members, and in most cases, very large members. You know, the FCM performs counterparty risk on many clients, and it's very unique circumstances client to client. So to envision a scenario where there are many exchange members and diverse in you know, the types of balance sheet, the types of leverage, and the things that we consider as a clearing member in our determination and assignment of limits. You know, I think that we as an ecosystem just need to be very mindful and considerate of how we proceed in that direction. You know, when that conversation was you know, pushed forward with the FTX proposal, you know, my view on that whole disintermediated model was really born of the crypto space as a matter of necessity, because many of the FCMs were and continue to gatekeep access to that space. So they needed to find a way, collectively the crypto space, need to find a way to generate access to allow for a properly functioning market. You know, I think this case in established markets and futures option swaps, you know, I think that we have the structure down. I think that we need to figure out a little bit more of refinement on the capital denominator. But hopefully we're not at the stage of trying to dive headlong into disintermediated. And I don't say that from the perspective of an intermediary who would become disintermediated.
Right. And just on the crypto, like my experience has been that even on the physical delivery marketplaces that are there, the FCMs are not accepting physical delivery for their customers. That either they're requiring them to liquidate or cash settle it, or they're using some type of wallet outside of the FCM system. They don't want to have it in their inventory or in their accounts for the customers. Another question that came up, which I'll ask Jeff and Matt might have the most about this: how does SPAN 2 rollout impact FCMs and end users?
Well, you know, I moonlight as a risk person, so I can speak semi-intelligently on this, but, you know, generally speaking, my understanding of the objective of whether it's SPAN 2 or ICE IRM 2, or that these are generally more risk-sensitive models, which will generally, in a well-diversified portfolio, reduce the margin requirement at the exchange. Now, the challenge that creates for clearing through a bank is that we have these very prescriptive models, and when we calculate our prudential models, not our own, but models to calculate exposures. Generally speaking, in futures markets, you're talking about a 1 to 2 margin period of risk. Under the prudential models, you're talking about a 5-day margin period of risk, right? So when you're reducing the amount of margin collected at the exchange and offsetting that in the risk context at the bank, it becomes more expensive, right? So I think that we all just need to think about how that's going to filter down to end users, but it may not be as good as advertised, I think what I'll say.
I think from the end user side, we're just learning. In fact, we just had a call with the CME not too long ago, and it was the very first kind of front run on what it really is. In fact, I don't think there's probably many end users in the room today that has had this discussion. But knowing my friends at the CME, I am relatively sure that my obligation to hold hedges, the cost of those is not going to go down with it. So understanding that it will probably affect capital requirements for holding hedges, particularly in risk in events that cause volatility to go up. I think the end user community needs to learn more about it, understand what's going to happen. It's not going to take effect, in my understanding, until late calendar 25 for the ag side. So I think it's just incumbent on us to learn and to understand and to go in it with some education about how it's going to change our capital requirements. But I certainly think it has the opportunity to do that.
Well, the nice thing about the way the CME did it is, you know, they've got a staggered approach by sector. right? So they've already got it in place for the energies now, so people can see the real life changes that it could have if they've got diversified trading. They roll it out to some other sectors this year, and then finally with the eggs at the end, knowing how much they appreciate the ag community.
Okay. And we have one last question, which I think I can answer. Are the people wanting to fund accounts with Apple Pay, trading in ag derivatives or other instruments, example, interest rate or crypto? And I think where it's coming up more is in the retail-oriented marketplaces, not necessarily with the more traditional FCMs and their customers, but there's a lot of interest in it and a lot of discussion that's coming very informally. Nothing's very, you get a lot of presentations or discussions where they're just asking for staff members' views, and nothing really solid has come out of that yet. We're just up at time now, but I'll ask each of the panelists, they have one thought that they'd like the audience to take with them from today's session. I'll start over with Ed and we'll go around.
From the end user's perspective, I think we appreciate the role the CFTC has played in trying to highlight these potential changes in these banking regulations. And I hope that the prudential regulators are listening and allow the experts at the CFTC a place in that debate, because it is. And it really, I'm been a little disappointed that the industry hasn't made as big a deal about it as I think they should have, because at this point, we don't have a capacity issue, but I think that would be on the horizon. So from our perspective, we continue to be, this is the #1 issue in 2024, to make sure that our voice is heard and reason maybe is highlighted in the way that they implement these new banking regulations.
I would just say, it's as automated and technical as everything gets. Futures trading is still a people business, and if you don't have that relationship with your margin clerks, with your risk team at your FCM, with your banker, it's more important now to have that open line of communication. To keep that in mind, and it's also important, just like you monitor your own your own credit card and credit rankings, to show a consistent ability to meet the demands that are put on you.
I think events like this are very important. So appreciate, Tom, your partnership from the DSIO side. And the CFTC certainly in their participation in these discussions around Basel III and the impact to the clearing community. I mean, I would encourage everybody who participates in these markets as an end user to understand what your footprint is in terms of the capital that you have with a firm, to better your chances of finding a place to clear and to navigate that conversation with the FCMs.
From a regulator's perspective, it's very interesting to hear the end user's voice, and you really don't see that when you go to an FCM to perform an examination. Our examinations are routine. We have a set of standards that we examine for in the areas we look into, and it's we're always looking at stuff on the macro level, customer protection of customer funds, that capital, but also, the people aspect of it is vital to hear as well. The end user, the employees, and the people that run it, to get that perspective. So, being here today was very beneficial, because NFA, they have, we've issued a lot of comment letters regarding some of these topics that have come up, disintermediation. We feel like the FCM performs a very valuable and functional role, and the continued consolidation is something to be aware of and to definitely monitor. Is there something that can be done about that?
Well, I think I'd like to thank all the panelists for participating. This has been I found it very informative, so I hope the audience did as well. But thank you for your time for coming, and I thank the organizers for having us. Right.
All right, hi everybody. Welcome back from the break. We are fortunate to have a full commission at the CFTC with 5 members. That is not always the case, so it's great when we do. You've heard from one of the commission members, Chairman Benham. We're not only fortunate to have a full commission, we're even more fortunate that the other 4 commissioners are here with us today in Kansas City to share some of their backgrounds and talk about their work and thoughts with regard to the ag space. Moderating the panel is Ann Wright. Ann has been with the commission for nearly 10 years and has led the CFTC's Office of Legislative and Intergovernmental Affairs for the last 3 years. Ann has accomplished a lot in her time at the CFTC, but most important for today, she's successfully guided each of these commissioners on this panel through their nomination process. Now Ann has the opportunity to chat with all of them as part of this conference. So please welcome Ann Wright, CFTC Commissioners Kristen Johnson, Christy Goldsmith-Romero, Summer Mersinger, and Caroline Pham.
Thank you, everyone. It's an honor and a privilege to be seated up here on stage with these distinguished panelists. I think like the other panel discussions, there will be time at the end of the session for a few questions. You all can be submitting questions through the scanned QR code. So I want to start off by saying it's been 2 years. March 28th, 2022, when the Senate confirmed by voice vote 2 Democrats, 2 Republicans to round out the commission, creating a full commission and historically the most diverse commission. These commissioners arrived at a time when Washington policymakers were eyeing potential increased roles for the agency as it relates to the digital asset marketplace, considering the financial risks related to climate, the evolution of technology in financial markets just across the board, and really unprecedented volatility due to the pandemic, post-pandemic situations, and geopolitics around the globe. So they arrived in a very vibrant and dynamic time, and so there's a lot to talk about. And I know that some of you know them, but I know that a lot of you don't, so we're gonna start off with a round of introductions, and I want each of you to share a little bit about your career path and how you came to the commission, and relatedly, why the CFTC. And I'd like to start with you, Commissioner Pham. Please.
Well, thank you so much for having me here. It's really such an honor to come out and talk to the people who actually are in our agricultural markets as producers, growers, and merchants. Do we need to do the disclaimer where we say that these are not the remarks of the commission?
No. That was your disclaimer.
Normally we have to do this very lengthy disclaimer, but so I'm really proud to say that this is actually my 4th time at the CFTC. I first started at the CFTC as an intern when I was in law school in the Division of Enforcement. And then I came back to the commission as a 3L in law school because my former supervisor in the Division of Enforcement had gone up to be a counsel to Commissioner Scott O'Malia. And so it was incredible being in the last year of law school, being here while the CFTC was implementing Dodd-Frank. All in all, I think at that point in time, the CFTC had done 67 rulemakings to implement all of the Dodd-Frank reforms. And I suppose this is where I'll steal a quote from a movie and say, I can't quit you. I have now come back to the CFTC as a commissioner, and I'm just so proud to be able to show what it looks like to have, homegrown talent here at the agency. We have a lot of staff at the agency that actually have been there for decades, and I think we might still have 1 or 2 people who've been at the CFTC since nearly its founding in 1975, which is very exciting because, as you may have heard, we are about to celebrate our 50th anniversary. The CFTC was first created with the passage of the Commodity Futures Trading Commission Act in 1974, and so we'll be kicking off a year of celebrations. And then all the commissioners, I think, got sworn in April of 1975. A little bit about my background. Definitely never thought that I would ever end up in Washington, D.C., certainly not as a government official. My story actually starts with my parents. So my parents were airlifted from the U.S. Embassy in Saigon on the last day of the Vietnam War, April 30th, 1975. And so I grew up in Vesto, California, which is where my parents ended up settling. My dad is a doctor, and rural communities need doctors, so that's how they ended up in the Central Valley of California. But I grew up with my parents owned peach and almond orchards, and I did 4-H and showed horses at the county fair and at the California State Fair. So ag has been in my roots, even though my career has clearly taken me all over the place to New York City and to beyond. But I think it's always important, again, to stay true to your roots, to understand why we're all here, where we came from, and to make sure that our agency is getting back to the basics, true to our core reason for being here, which is that our market started because, again, producers and merchants needed markets to be able to hedge their risk, and you need regulators of markets. And so I kind of always want to remember that. So thank you so much.
Commissioner Goldsmith-Romero.
Oh, sure. Well, it's really nice to be here with everyone. Thanks, and for putting this together, and thanks, Chuck, and everyone for putting this together. I really appreciate it. So I came from a military family, which inspired my federal service. So 2 decades as a financial regulator in the federal government. I spent 6 years at the SEC as a market regulator, and I was in enforcement, and then I went up to be counsel to Chairman Christopher Cox, who's a Republican, in December 2007. So if you think of the timing of that, that meant that the crisis hit, and I was counsel to the SEC chairman. And then I stayed with him through the crisis, and then the turnover to Mary Shapiro, Chair Mary Shapiro, who's an independent, and stayed with her for some time. So was really left quite an impression on me, and all the decisions we were making had just such tremendous consequences. So it was really a tough situation, but one where you're sort of forged in steel. And then I went over to Treasury, and I served there for 12 years. And one of the things at Treasury is, so I went from being a markets regulator to then looking at the economy. And so once you start to see the economy and all the different industries that play into it and the interconnections, you can never really go back, right? You put markets in there, but you think about how all of these different industries are economic drivers. And so for the last decade, I was the Special Inspector General over the TARP bailout. So that's 700 banks. That's General Motors and Chrysler, right? Automotive industry. That's the insurance industry. That's the housing industry. That's community lending. That's small business lending. And that is certain derivatives. And so I did that all the way up until March 2022 when I came over to the CFTC, and I was really interested in the CFTC because agriculture and energy were 2 industries that I had not worked in. And so that was actually really fascinating to me, because to be able to see these industries as economic drivers is really important. I still sort of see things through the economy lens. And so I just thought the CFTC was at the center of so much that was going on. And also I get to be a market regulator again. So it's been really great.
Terrific, thank you. Commissioner Mersinger.
Thank you, and it's great to be here. Thanks to our Kansas City team. I know it's probably a lot of extra work and stress to have all of us here, as fun as it is for us. I doubt it's as fun for you, but thank you. You guys have been very gracious, and thanks to the Kansas State for hosting this as well. So I get the question a lot, how do you become a CFTC commissioner? What's kind of your career path? And I don't know if there's we all have very different career paths, so it's hard to pick, what did we do? But I grew up in South Dakota, so, Midwestern. My dad's a farmer, my mom's a banker. So I guess it kind of makes sense, right? Like this is what you do. But I actually spent almost 20 years working for my home state congressman, and then became a senator. And so I was doing a lot of on Capitol Hill, and I was doing some policy. And
at the time, somebody who had been doing all of our banking and financial services policy had left the office, and the chief of staff at the time said, would you mind taking on the banking and financial services portfolio? Not a big deal. You meet with the South Dakota bankers and the South Dakota credit unions. They come out once a year, easy stuff. Well, that was in 2007. So it was not long before the 2008 financial crisis hit. And it was just this onslaught of, policy and really, situations that no one had seen before. And everybody was trying to deal with this, kind of in the moment. And I really did it was very eye-opening. I learned a lot about financial services, certainly about the CFTC as their mandate was getting expanded. At the time, my boss was on the Senate Agriculture Committee. So, it really just, I learned a lot about the agency. And, it just kind of from there became, a natural place for me. I did work at the agency for a while with Chairman Tarbert. I worked closely with Ann. We had a great time during the pandemic trying to navigate that. I also went and worked with Commissioner Don Stump. Don and I, our kids were at the Senate daycare together, so we had this kind of interesting, we knew each other from the Senate and from the Senate daycare. But it's been, to Carolyn's kind of quote about the movie, I think, as Chairman Tarbert moved on, I think everyone's like, well, what are you going to do next? And I said, you're never getting rid of me. And I think people thought I was kidding. But then I became a commissioner. And then I was just I had so much fun doing confirmation the first time with all of you. I thought, I'm going to try it again by myself. Not as fun doing it by yourself, but again, I've got a full term here, so you're never getting rid of me. But yeah, no, I think we all have very unique backgrounds, and I think that's what makes this commission so dynamic, and we just bring a lot of good policy perspectives to what we do every day.
Thank you. And you, Commissioner Johnson.
Hi, Ann.
Hello.
So I guess I said earlier this morning, my mom is from Michigan, my dad is from Texas, and my dad's from East Texas, actually, which many of you might know as cattle and cotton country. And so some element of being here in Kansas City is just like being home to me in so many ways, though the barbecue is different. That apart, I've spent a majority of my grown-up life in a few places that I think the agricultural sector of our economy really thrives. That's Michigan, Texas, but also Louisiana and Georgia. And our Midwestern and Southern roots and commitment are really long and deep. During the confirmation hearing process, I shared with the Senate Ag Committee that my mother's great-great-great-grandfather moved to and helped found and settle a small town in Indiana in the early 1820s. And there he had a tremendously small scale set of businesses, but he lent money to his neighbors to buy land, to buy cattle, to buy feed. And it's nothing someone would write about in the history books per se, but it really was the beginning of our family and part of our family's story and history here, and I think part of our country's history, to be very clear as well. So I didn't actually know all of that until I was asking my mom what could be interesting about our family to talk about during the confirmation hearing process. What was really my story and not their story is I've always been interested in economics, but I had a bit of a passion for agricultural markets and the things that, the ways that agricultural markets help lift societies to and elevate societies to new places. And so I was an undergraduate student at Georgetown studying economics and sort of dug into agricultural economies in Eastern and Southern Africa. And full circle, as a commissioner the week before last, I was in Zambia in South Africa, and I was visiting farms, and I was talking about carbon offsets because I continue to be wildly passionate about the things that we can do using the land that is before us. And so this conference feels really exciting and comfortable for me in many ways, but also like a tremendous place to learn a ton of things that I don't know much about. Because though I have this interest as an undergrad student at Georgetown, it manifested in my going onto Wall Street and working for a few large financial institutions, and then becoming a lawyer that managed contracts in mergers and acquisitions, for securities offerings, public and private offerings, and then learning a tremendous amount about credit and syndicated credit facilities. I decided in the summer of 2007 that in 2008 I would leave this Wall Street background and become a law professor. And everyone asked if I was serious. And my managing director, in fact, said, you should just take a leave of absence. You shouldn't actually leave. But by September of 2008, it was clear I had very much made the right choice. Some asked if I was prescient, and then others asked what kind of position I must have had on at the time, because I left the bank just as we saw significant contraction in credit markets and the onset of a global financial crisis. That actually spurred the entirety of my scholarship as a law professor. I wrote almost exclusively for 6.5 years about clearing and standing up mandatory clearing under Title VII of the Dodd-Frank Act. I was invited to the CFTC as an expert to talk about the rules we would organize for clearing. And I remember being invited into the building, or being invited to come and entering the building, and just being awestruck in the moment of my participation in a round table with 50 other people talking about clearing. It was one of 100 round tables maybe. But I had the exact same feeling when Anne welcomed us to the building to have conversations about the upcoming confirmation hearings. I feel very, very, very fortunate to serve this community, and I'm really hopeful at all times that I'm doing a decent job at it, and I'm not opposed to criticism. So grateful, Anne, to be in this space, and really looking forward to the conference.
Thank you so much. So it's been 2 years. You've been on the job. I'm sure that some days that feels like a lifetime, other days it feels like just yesterday. But can you just take a few minutes to talk about your day-to-day life as a commissioner? And I'm going to have you start, Commissioner Johnson. Just a few minutes about the day-to-day life of being a commissioner at this.
Well, I think I already told you I ran to Zambia to check out some farms there. I've also been, I did a little bit of a cattle drive in Kenya. And this is alongside the deep and complex engagement in the rulemaking process, oversight of enforcement matters that requires thoughtful, fair, reasonable assessment of the issues that come before the commission, and then oversight of the advisory committees that each of us sponsors. I am the sponsor for the Market Risk Advisory Committee. I inherited it from Chair Benham. And this past Monday, we had a meeting where we spent a significant amount of time talking about a letter we'll send to the commission shortly on FCM concentration and capacity. So the last panel felt also very familiar to me. We've also organized a formal report on DCO recovery and resilience, which is to ensure not only that FCMs operate with the highest level of integrity, but that in the event of defaults, we can ensure against any losses related to DCO's, a DCO's failure. So I think, the opportunity to work on some of the coolest issues that come across our desks as a commissioner. And I think it keeps us pretty busy.
No question. Commissioner Pham.
So I realized I forgot to tell you about the last 10 years of my life, maybe because I was trying to forget it, but probably not. I was previously a executive at Citigroup. So when I left the CFTC in 2014, I went over to Citi to be in compliance to help to implement the Dodd-Frank Act. And so I was the global head of swap dealer and Volcker compliance. I then moved into the legal department and was the deputy head of global regulatory affairs, overseeing all of Citi's global regulatory advocacy, all countries, all jurisdictions, all regulators, on the biggest top of house issues for the firm. I then went into the chief administrative office of Citigroup to support the CEO and the board, and looked at some of the important strategy of the firm. And then my last role was actually in the front office, where I was in the investment bank's business development team as the head of market structure for strategic initiatives, looking at how, again, from a strategy perspective, financial products and services would be changing over time, and what our clients' needs be. And in particular, I was looking at digital asset products and services, sustainable finance, and other new opportunities. So my day-to-day now at the agency is like going back in time to when I was counsel to Commissioner Scott O'Malia, and not very much like what it's like working at a big bank in New York City. But I think there are still two things that are really key to any job that you're doing. So as a commissioner, I feel like the two key parts of my job are I vote, because as the head of the commission, it takes all 5 of us to vote on something to actually take an action of the commission. So I vote, and hopefully I make good decisions that I'm on all the matters, whether it's an enforcement action, a rulemaking, or any other type of agency action. And then the second main part of my job is to meet with the public, because I'm here to make sure that everyone has a voice, that they have somebody that they can come and talk to, and that they can participate. We are in a participatory democracy, and so it's important that all views get heard and in Washington for the important decisions that we're making that are impacting different markets, different industries, and your lives, your businesses, and your lives. Meeting with people helps me make good decisions. And so that's why I spend probably most of my time is whether I'm traveling and meeting people where they are, or they're in New York or in Washington, I'm meeting with them there, or I'm speaking at a conference like today and being accessible to meet with people. And so I'm sorry to everybody that was late with meeting earlier today as I tried to rush around from meeting to meeting. But I think it really just boils down to that. There's a tremendous amount of reading, writing. We get terrific briefings from our staff. It's been a pleasure for me to work with our CFTC staff, who again, many of them I've known for almost my whole career. Probably like most jobs in Washington, involves an awful lot of talking, a lot of job owning.
Well, thank you. Commissioner Goldsmith-Romero.
Oh, sure. So for 21 years, I start and end every day by looking at the markets. This is just what I do. This was like ingrained in me at the SEC that that's what you do. Only here, I'm looking at a broader set of markets, an additional set of markets, I should say, because I still look at the other markets, equities markets and all of that. But now I'm looking at the agricultural and energy markets and seeing what is happening in there. And then I do deeper dives into that. So when I started reading about what was happening with cocoa, that was me reaching out to the economists at the CFTC to say, can we dig into this more and get more market color? And oil, of course, is another one. Then it's also sort of meeting with staff. Next week, I'm having a deep dive on the supervisory stress tests that we've just done for the DCOs. So it's a lot of sort of figuring out what is going on in markets, and just and then it's meeting with people to see, like, what are the challenges you're facing? Are these markets working? Question I asked at the Agricultural Advisory Committee this morning was, small farms actually able to trade in our markets? I've had a couple meetings on that already today about sort of economies of scale and things that could prevent use of actual trading in markets, but maybe using our markets for pricing and cash contracts. So my highest priority is making sure that the markets are working. And if we look at our mission, that's sort of the promoting the vibrancy of markets part. Then there's promoting the resilience. And so I spend a lot of time on the resilience part, resilience to risk, all kinds of risk. And so when I think about resilience, that's the ability to bounce back quickly from setbacks. So we think about what happened during the pandemic, Russia's war in Ukraine, climate issues, cyber issues, all of that, sort of saying, like, what are the things we could do to promote market resilience? Third part of our mission, market integrity. I spend a lot of time on enforcement. I have been an enforcement person in the federal government for 2 decades and led a law enforcement office at Treasury. So I sort of work on all that, and then I'm also focused on financial stability, like I would, since I've been working on crisis issues and post-crisis strengthening of the financial system, as well as sort of looking at consumers and users. What's the impact? That sort of ties into our markets working, the first priority. So, and then of course we all sponsor an advisory.
Commissioner Mersinger.
Well, Commissioner Pham mentioned reading. We read a lot. A lot of my day is consumed reading. I see Chuck smiling and nodding his head. He's part of the problem, actually. Let me tell you that. But we read a lot. We get a lot of information. We have to intake a lot. And, you know, I think my day-to-day activities probably would go a lot differently if we didn't have really good staff to help us out. So, you know, in doing a lot of that reading, you come across things where you have a lot of questions. And I know I harass my own staff a lot. We've got, we each have 3 staff members, and, you know, I rely on my staff a ton. And, you know, there are times where they don't have the answers, or you know, they want to confirm. And so then we're really relying heavily on this staff within our various divisions. So a lot of it is getting information through reading, also engaging with staff to get more information, and then meeting with stakeholders. And that is very important because, you know, we sit in Washington, we miss out on some of the day-to-day happenings. And so we have to talk to the people who are actually in these markets, who are actually using them. And that's critical to help us make the decisions. So when we do get to a vote, you know, we know what we're voting for and why. And, you know, there are times, you know, we've got travel. We meet with other regulators, both domestically and in other countries, because our markets are global. But, you know, I think I can't kind of overemphasize how important the staff is to help us do our job, because I think, you know, if it was just us, it would be a very, very interesting, you know, journey. But you know, and I think we all kind of have a little bit our own priorities. So, you know, we all kind of do our things a little bit differently. But I think probably here's some themes when we talk about what our days involved, and it is, you know, pretty similar.
Thank you. So the agency sponsors or hosts 5 public advisory committees, and each of the commissioners, including the chairman, sponsor one of those committees. Those committees serve as a public forum on the record for the agency to invite industry, trading firms, market participants, end users to come to the table, discuss challenges and opportunities, problem solve. It's a very dynamic place, and each of you have done considerable work in that context. I wanted each of you to take a minute to talk about the work of your advisory committee and some of the key issues that you've been focused on. And I'm going to start with you, Commissioner Goldsmith-Romero.
Oh, mine is so fun. Mine's the Technology Advisory Committee, which is very fun at this day and age. And I've kept the membership very small because the idea of this committee is it studies the intersection of technology, law, and policy. That's what our charter says. And when you do that, there's this just natural rub and debate because technology is evolving while we're studying it, right? And how it's used in our markets and what is happening. And so by having this very small, tight group, I think of technology experts, I think what we've done is built a safe space where people can feel free to disagree or say, have a different view. I have 3 subcommittees: digital assets and blockchain, cybersecurity, and then emerging and evolving technology. So spent a lot of time on AI on that one over the last, you know, more than a year now, and then did some work on cloud. The cybersecurity one's been pretty important right now. And so what we've done on the digital assets and blockchain subcommittee is we released a report on decentralized finance. So I said I was in enforcement. I did a lot of work on illicit finance, so I prosecuted money laundering cases, which is why my house is grayed out on Google Earth. And so decentralized finance is where a lot of that is coming in. And the members on the Hill in Congress were really struggling with what to do with decentralized finance as they're bringing up all these bills. I got a lot of questions on that. And so what I had asked the subcommittee to do is really just kind of focus on what is decentralized finance, like what is it and what does it actually look like now? and versus what the promise of it is, to explain it's not just one thing, it's an ecosystem. How do you talk about accountability? What are the opportunities? What are the risks? How do you deal with illicit finance? And then I've been on the Hill talking with legislators about that report, which has actually been received pretty well by both Republicans and Dems, which is nice because we have these balanced committees. It's a very balanced report. And so then our emerging and evolving technology group has been working very heavily on what's known as responsible AI, which is like basic principles: fairness, transparency, accountability, safety, safe and secure, the basic parts of it. Explainability is sort of like this is where you don't want the AI to sort of take over and it's humans are involved. So that's been also a very interesting place to be, because AI has been around and used in regulated financial services for a very long time, but it's just this generative AI that's become sort of the buzz. And I think a lot of people are still trying to figure out what to do with it, how they're going to use it. So we should look at sort of the basic foundational principles and that kind of thing. So it's been very fun. And then we'll be moving into more on blockchain technology, which is a really fascinating area, and then more on cybersecurity. So it's very fun for me, and a lot of interesting things with a lot of very interesting debate. And we have, for example, when we talk about crypto, we have crypto industry, people who hate crypto, who are very skeptical about it. We have public interest groups, we have academia. So we get this really great 360 view. And the thing I always say to my members is, like, I absolutely encourage different opinions, differing opinions. I'm not looking for consensus here. I'm looking for a more rounded, well-rounded argument. And they find things that they can get to consensus on, which is always nice.
Cool. Commissioner Pham.
So I am pleased, and this is great because it really fits well with my work experience and expertise. I'm the sponsor of the CFTC's Global Markets Advisory Committee. Now, this advisory committee was actually first started in the 90s because it was to address the fact that there was increasing globalization. The markets are increasingly global, and to make sure that American firms would be competitive on a global stage. And so what I've been pleased to do in relaunching the GMAC is really it's about having a level playing field for global businesses and global markets. It's understanding not only how our rules should apply in a cross-border perspective when we have US firms that are doing business in other countries, but also about non-US firms that are participating in our markets. And then more broadly, what are the shifts of capital around the world? What are the issues around market structure or market access? And how are international standards for markets put together? So we have three advisory subcommittees. So we have the Global Market Structure Subcommittee, the Technical Issues Subcommittee, which deals with a lot of market infrastructure and technology type of issues, kind of the pipes and plumbing of markets. And then the last one, which is digital asset markets, as people in particular are increasingly looking to tokenize existing financial products and services and put them on a blockchain. Kind of the same way when everybody moved to electronic trading. So moving from open outcry and pieces of paper, doing everything on electronic trading screens on the computer, and now maybe using this new technology and having everything be digital on a blockchain. So those are what the work is really organized around. One of the things I wanted to do, particularly in my role where I used to oversee a $1 billion compliance program, I had to implement global regulatory reform, not just the Dodd-Frank Act, but also the CRMER and MiFID in the EU, and then also some of the different regulations in Asia across the global markets business, across equities, fixed income, commodities, rates, currencies, and more, is to really understand the interconnectedness of these different regulations and to minimize where regulations might be duplicative or conflicting or create rules that are not workable. So in doing all of that, one of the things I thought was very important, given that our markets are global, is that we look at, in particular, the Financial Stability Board agenda and have a committee at the CFTC that is tracking against that Financial Stability Board agenda to make sure that our expert input from committee members is being funneled into these international forums and has a chance to influence and impact the development of those international standards. So I've been very pleased with that. In the past year that the committee has been up and running, we've done 11 recommendations that have spanned different markets, whether it's US Treasury markets, to commodity markets, to interest rate markets. And so I've been pleased at, again, seeing how we can come up with practical solutions to some of the biggest challenges facing global markets. Some of them are more high level, other are very technical, whether it's looking at exchange market volatility controls, given what happened with nickel and energy markets during COVID, or in looking at some of the transformation of the Treasury market structure and what different impacts there might be. So been very pleased about that. And then most recently, also the committee had a recommendation on a digital asset taxonomy, which we hope can provide some foundational concepts that will help US policymakers make some progress on regulating digital assets, and also to promote international alignment of what we're doing here in the US with, again, these international standards from the Financial Stability Board and from the International Organization of Securities Commissions. Thank you.
Commissioner Johnson.
Hi, Ann. So I said just a little bit ago, and I actually think the panel just ahead of us did a great job covering some of the issues that the Market Risk Advisory Committee focuses on. I'd share, I guess, a couple of highlights over the last couple of years that really reflect where I think the advisory committee can really be of value to the commission, and also can act as a forum for convening really different and diverse perspectives and integrating those, acknowledging that there's not always perfect consensus, but there are important views that the commission should take into account. So let me give a couple of examples. One, referenced in the immediately prior panel, Tom Smith noted that the events at ION deeply impacted a number of FCMs. And so in March of last year, MRAC convened to address the market risks that can arise from cyber threats, but particularly from critical third-party service providers that FCMs might rely on, like ION and its cohort. We need to develop and sort of begin to see our way toward different resilience responses. So we asked Tom Sexton from NFA, former CFTC Commissioner Walt Lucan from FIA. We invited speakers from market participants. CME participated in the discussion. We invited someone from the National Office of Cyber at the White House to come and talk to us. And what we did in that conversation was begin to remember some of the sort of very valuable interventions that this community and the broader community that might rely on derivatives markets have used to identify market risks like cyber risk and to address those market risks. Because it's important that the commission is continuously reminded that there are many different users in our markets and that the risks might impact those different users in different ways. So I think that was a really valuable public conversation. It's the only one we've had at the commission on the issue of that cyber threat formally. And I think it was a great launch to a continuing conversation that could happen in each of these advisory committees and could continue to be part of the dialogue on a couple of different levels at the CFTC. In addition to that, convening in the discussion there, I referenced earlier that at a meeting on Tuesday, the Market Risk Advisory Committee adopted recommendations that will go to the commission that are explicitly focused on CCPs and how to ensure against default for some of the CCPs that are not the largest CCPs in our markets. We have living will or recovery and resilience plan for those SIDCOs. We don't have nearly, we think, as refined plans for addressing a significant liquidity crisis for other DCOs. So the commission has proposed a rule, and MRAC took time through a subcommittee to carefully curate the perspectives of a diverse group, including end users, FCMs, the CCPs, and to aggregate all that we discovered in the context of our conversation to point out where there was consensus, where there was divergence of views, and to highlight and underscore some issues we thought the commission should focus on. Among the recommendations, we explicitly asked the commission to think about and adopt and implement supervisory stress testing for of credit and liquidity risks for all DCOs. We encourage the commission to adopt and implement operational and other non-default stress testing. We encourage the commission to include reverse stress tests in their supervisory stress test. We encourage the commission to take on, with respect to Regulation 39C2, some additional analyses to deal with extreme but plausible scenarios that could trigger recovery or wind down. We encourage the commission to think about non-default losses and the allocation of non-default losses, particularly in light of the historic structure of how intermediated markets work and the extent to which there is at least some probability, if you haven't carefully considered how non-default losses will be treated, that they could be absorbed by certain participants in markets that we might have thought not to have had exposed to those losses. Third, we spent a lot of time on a letter that's coming to the commission shortly on FCM concentration and capacity. And the last panel spent significant amounts of time describing diminished capacity and the decline in the total overall numbers of FCMs in intermediated markets. There was also a very clear expression in the previous panel that there might not be an appetite for disintermediated markets. Well, this poses a real challenge because part of what we had hoped to do was begin to uncover some of the reasons. We haven't quite gotten to causation, but we can see correlation. Some of the reasons that there might be a reduced number of FCMs, particularly in a moment when there's increased clearing activity. So all of you are likely familiar with any number of data points related to FCMs, but by way of example, 10 FCMs account for more than 80% of all customer funds. In addition to the consolidation of 80% of customer funds held by 10 FCMs, the MRAC subcommittee observed an increase of 296% in overall adjusted net capital. Over the 20 years of data that we looked at, the publicly available data on the CFTC webpage, we noted that the sum of all firm adjusted net capital was US $45 billion. And in 2023, it was north of 175 billion. The thought around how the market has shifted, the market structure has changed with increasing lower probability that there will be new entrants in the FCM space really motivates deep thinking about the market risks that can arise, the concentration risks and capacity risks, and as was referenced in the last panel, the challenges with porting in the event that an FCM suffers a liquidity crisis and is no longer able to perform its duties for its customers. These are just some of the issues that we've been studying very carefully in MRAC, and I'm hopeful to continue to support the Commission in its understanding of the different community perspectives on these matters.
Thank you. Mercier.
Yeah, so I sponsor the Environmental and Energy Environmental Markets Advisory Committee. And when we were talking about kind of what advisory committees we would all end up with, or we would all pick, I was very focused on the idea that, energy is the number one kind of input cost for farmers and ranchers. And I had worked with former Chairman Tarbert on the Agricultural Advisory Committee. And so I wanted to do something a little bit different, but also with, tied into my background. And so energy and environmental markets made a lot of sense. And we have done some great stuff in this advisory committee. We actually just had a meeting on, was that Tuesday? I'm losing my days here. But at that meeting, we talked about the Basel III prudential regulations on how that could affect some of our markets. It was a follow-up to a previous conversation. We talked about just some of the indexes that some of our contracts settle to, energy contracts settle to. We also talked about energy transition, which has really been a theme for EMAC, because I think there's an interesting shift here from our markets that, our traditional energy markets are oil markets, which are very liquid, heavily traded, contracts that have been around for a long time. And now we're starting to see an uptick in some of these, critical minerals and metals that maybe weren't as used as much before. And now they're going to become an important part of the energy complex. And so, just talking about what do we need to be thinking about at the commission as we see this kind of shift. The other cool thing that we've done with EMAC is, we've tried to have meetings outside of Washington. We've done what we could to hold those meetings in conjunction with universities so that we can kind of reach some college students and grad students and others who, wouldn't have the ability to sit through and hear these discussions unless they wanted to, log on to our virtual and watch our meetings virtually, but we're having them right in their, in their student unions or, close by. And we had a great meeting here. We had a great meeting in Colorado where we actually had students presenting on kind of things that they were working on. They were all grad students. A lot of them were in the metals and minerals and mining area. They did these amazing presentations. So it's been kind of neat to use advisory committee, which is, I think the CFTC does a great job of using that forum to hear from stakeholders. And we've really tried to kind of partner with universities and colleges to, both get out and kind of have these discussions outside of Washington, but also reach kind of the next leaders in this space. So that's been great. And I can never talk about EMAC without talking about my rock star secretary of EMAC, Lauren Fultz, who's based here in Kansas City. She has a full-time job as an investigator in our enforcement team, and she does amazing work planning these meetings, putting them together, and literally I just show up. So I think Lauren's back there somewhere, but yeah, give a little round of applause to Lauren. But it's, again, we rely a lot on staff, and certainly all of our advisory work, I think we would not be able to do it without our staff. And then of course, all the advisory members who not only bring their expertise, but they do a lot of work in these advisory committee meetings.
Thank you. Thank you so much. So I did have another question to present to the panel, but I'm looking at Chuck. You can just cut me off. Just very quickly, I wanted you to go through, starting with Commissioner Mersinger, and just talk very briefly about what you consider to be the top 2 or 3 issues facing the agricultural future markets in the coming near future. Those markets are, and the commercial end users in those markets are the backbone of the derivatives markets for us, and certainly for this conference. And I think that would be a great way to round out.
We have to do this in a speed round.
We could do a speed round.
Yeah, I'll do a speed round. And I'm, because I get to go first, I get to, the low-hanging fruit here is the FCM access, FCM capacity, access, having, enough FCMs, making sure that farmers and ranchers can actually get to these markets that they need to hedge. So that's number one. Another thing that I think we talk about a lot is, kind of liquidity and these markets being available for hedging. Some of these smaller agriculture contracts are lightly traded. They're not as liquid, but they're critical to end users. And so I think just making sure that the end user, the farmer, the rancher who needs to use these markets to hedge, that those markets are available and they're able to access them and do so in a way that, that's not unnecessarily burdensome.
Thanks. I agree with Commissioner Mersinger, and I just also add number one, macroeconomic and geopolitical factors that are impacting the agriculture industry. As I said earlier, the agriculture industry is about 20% of the U.S. economy. Agricultural exports are a huge piece of that. And, we are seeing some really important geopolitical shifts that are going on right now where we seem to be moving from a unipolar world to one that is multipolar. And we have a lot of agricultural production coming online all around the world, whether it's in Brazil, whether it's China, whether it's in Africa, and that's going to be impacting American agriculture. So understanding all of those geopolitical shifts and international trade policy and how that's going to impact the markets that people are using to manage the risks there, I think that's very key. And then the second piece of it, which is very different, but still along the lines of being in touch with the agricultural sector, is it would be great, I think, if we had an ombudsman at the CFTC, and I know other commissioners have spoken about this as well, that is doing outreach to the agricultural community. Commissioner Mercinger's talked about this in the past. I think other commissioners have in the past as well. I've been putting together different proposals for creating a dedicated office to it, or maybe having it within, as I think Commissioner Mercinger suggested, the Office of Consumer Education and Outreach. But even at a big firm like I used to be, government agencies are a bit of a black box. And so having a place where you can go to get some basic information to help with understanding why or why not should a smaller grower, producer, or merchant be looking at using futures or options as risk management products, I think that would be very helpful just to make the agency more accessible, and also having somebody just to help, again, navigate what Washington is like. We sometimes forget that it's not that the economy and the markets are driven by Washington. Washington is here to liaise with and understand and connect with and develop policy. So it's not the tail wagging the dog, it's the dog that wags its tail. So that's why I think it's important to make sure we have these public forums.
I'll be quick. Resilience in risk management, because we're just going to have these issues come up, these geopolitical risks, and all of these interest rate risks and what happens with that. Cyber risk is major, and then I'll end on climate risk. But for me, the idea of trying to look at resilience and trying to figure out when we hit a market stress event, which we know will happen, how could we recover quickly? How could we get the liquidity that we need, the access that we need? How do we navigate difficult geopolitical factors? How do you come back from a cyber attack? What do you do in a climate situation?
Thanks, Anne. I'll say I'm really only echoing, but I want to offer some examples of a couple of the risks to be managed that I know are top of mind for many of you, because I think they're top of mind globally. I mentioned that I was in Zambia. The drought there is so severe that even the power and water flow over the Victoria Falls waterfall is deeply impacted. And that's saying nothing in comparison to possibly the logistical costs that have been borne by a lot of folks in this room, as the low water levels on the Mississippi River have made transport more expensive, logistical costs higher, shipping costs higher. Now with the Panama Canal also experiencing low water levels, and there being real challenges with shipping lanes coming out of the Middle East, and then more recently even the collision between a barge that lost power with the Francis Scott Key Bridge in Baltimore, creating further pressure on shipping and logistical costs. I mention all of this because I'm simply saying, apart from the geopolitical events that we certainly are exogenous to markets, there are climate-related risks that are directly impacting the costs of inputs and directly impacting margin and profitability. And I think we have to sort out how we'll manage for these risks. I'll also just emphasize on the interest rate risks that Commissioner Goldsmith-Romero mentioned, and I think we talked about earlier today in the Ag Advisory Committee meeting, that it's the interest rate risks and inflationary pressure. And the inflationary pressure is coming on the heels of what have been a series of significant challenges for many in this room and in markets. The onset of the COVID-19 pandemic, the geopolitical events in Ukraine creating pressure in energy and wheat markets, sort of amplified over the last several years by additional geopolitical conflicts. I think there are risks that we need to adjust our models to take into account, and ways that we at the CFTC probably need to begin to study those risks and understand those risks to help create a pathway that enables everyone to be prepared for those risks. So I'd stop there, Anne, but thanks so much.
Thank you. Well, this has been a full hour, and I want to thank you, each one of you, for being here today. Thank you for your service to the CFTC.
And to you.
Yeah. And thank you all for being here.
Thank you. Thank you.
All right, thank you, Ann, and thank you, commissioners. We're going to mic up the next panel. So before I introduce the next panel, I just want to acknowledge how special it is to have all of the commissioners here. I definitely don't take it for granted that you get any body like that outside of DC to come to Kansas. So it means a lot that they do, and it says a lot about this commission and the previous commissions and like this agency that every time I have asked all the commissioners to come to Kansas, every single commissioner has said yes. So thank you for that. So our next panel is going to examine illegal conduct in cash commodity markets. Specifically looking at how and under what circumstances the CFTC and the Department of Justice bring actions related to cash commodity markets. The CFTC's jurisdiction over derivatives markets is well known, but I think this panel will highlight the CFTC's enforcement jurisdiction over cash commodity markets. Moderating this panel is the CFTC's General Counsel, Rob Schwartz, who has led the General Counsel's office for more than 3 years and has been with the CFTC since 2011. And joining Rob as panelists are a current CFTC prosecutor, a current DOJ prosecutor, as well as someone who formerly was both a CFTC prosecutor and a DOJ prosecutor. And that third person also was my boss, which puts him in a whole different category. So I'm going to let Rob introduce everyone when he gets up here, but please join me in welcoming Rob and our esteemed panelists.
Then, was it, Chuck? Hello, Eitan.
Hello, Robert.
All right. Thank you, everybody. I'm Schwartz, I'm the General Counsel of the CRPC. I've been in that position for over 3 years now. I've been at the agency since 2011. I feel compelled to do my own agricultural. Hey, Rob, you gotta fix your mic. Gotta fix my mic. Wow. Oh, it's on. How's that? Oh, that's a lot better, right. Thanks, Vince. I was about to give my own agricultural bona fides. It doesn't go back as far in history as Commissioner Johnson, but my great-grandfather owned a dairy farm in the East New York neighborhood of Brooklyn. It is now one of the very most dangerous neighborhoods in Brooklyn, and my mother grew up going there. And this may seem normal to some of you in the room, but she likes the smell of cow manure because it reminds her of growing up. So that's my connection to agriculture. It did seem peculiar on Long Island where I grew up, and the nearest farm was, I don't know, probably around here, I have no idea. With me today are, starting from immediately to my left, Eitan Goldman is a partner at the Zuckerman Spader law firm. He was previously, though, Director of Enforcement at the CFTC. Next is Michael Neal. He is an Assistant Chief in the Fraud Section at the Department of Justice. And at the end is Rob Howell, who is Deputy Director of Enforcement in our Chicago office. And I guess before we begin, I will just give the general disclaimer that those of us from the government are expressing our own views and they don't necessarily represent the views of our respective agencies. So why don't we get right to it? There is, as Chuck said, we are the Commodity Futures Trading Commission, and our jurisdiction includes other derivatives as well. but we do have some authority relevant to cash commodity markets. So we're going to talk a little bit about that today. So in that vein, Rob, what is the CFTC's authority in cash commodity markets?
So the CFTC has general anti-fraud manipulation. Is this loud? Sounds loud to me. But, general anti-fraud manipulation enforcement authority for commodities and interstate commerce, and that comes from the Commodity Exchange Act 6C1 and Rule 180.1. Do you want to explain the difference between that authority and the futures?
Right. Yeah. So as Rob said, this is general anti-fraud and anti-manipulation authority over contracts of sale of any commodity in interstate commerce, whereas, of course, the agency has much broader regulatory authority over futures and other derivatives. And this is all the sorts of things that you're familiar with: registered exchanges, market surveillance by the CFTC, registered intermediaries, customer protection, cybersecurity, asset segregation, et cetera. And there's also a couple of enforcement provisions that are of a different character that pertain to the derivatives markets. It's what we call them, quote, non-scienter provisions, which for the non-lawyers in the room means there is no requirement that you have to prove an intent to defraud anybody. Whereas in the anti-fraud authority that Rob was describing, you have to prove that the person either knew that they were making a misrepresentation or were reckless as to the possibility that they were misrepresenting, whereas certain provisions in the futures and derivatives space, you don't have to make any showing like that. Mike, what tools does DOJ use to get at wrongdoing in commodity markets?
Sure. Firstly, it might help just to contextualize the fraud section in our unit in particular. So I'm part of the Market Integrity and Frauds unit. We are in the fraud section of the criminal division of the DOJ. So part of Main Justice, we're based in Washington, D.C., but we investigate and with our law enforcement partners in close coordination with the CFTC and other regulatory partners, we investigate and prosecute cases all over the country. And we've got about 45 prosecutors in the office focusing on securities, commodities, crypto, digital asset fraud schemes, as well as a government procurement, government programs fraud types of cases, and just other corporate and investment fraud schemes. And just echo the disclaimer, Rob, that you gave for all of us earlier. And I think one of the things I think in terms of tools that we use to get at commodity fraud, both cash commodity fraud and fraud in futures and derivatives markets, I think of it, in sort of two buckets. One is lead generation, and the other is more investigative tools in our criminal toolkit. And I think these are generally applicable, but they're also tools that we deploy in these markets for sure as well. And so I just want to highlight a couple of examples or buckets within lead generation. And these are, I think, also good examples because each of these categories is one that is really facilitated and enhanced by the cooperative enforcement relationships we have with the CFTC, including Rob's office and the Kansas City office right here in this region. So in one of those, in lead generation, is data analytics. And we're looking, both with our colleagues at the CFTC and the data scientists and experts that they have in-house, as well as our own in-house expertise, and working with law enforcement partners and with expert consultants, really, I think have in my experience over the last decade at the department, have really sort of pioneered and developed our use of data to detect anomalous trading activity and market abuse in trade and order data, particularly in futures and derivatives markets. But we'll also talk about some examples where sort of data analysis can identify outliers and red flags in other fraudulent schemes as well. So I think that's one toolkit that we really have enhanced, I think, in our office in particular, in terms of lead generation. And then also, as we get into a more investigative phase, analyzing data in more detail as well. Another bucket of data, not market data, but we are also looking in our office and my colleagues in the Foreign Corrupt Practices Act unit, which is part of the fraud section as well. We're looking at suspicious activity reporting and sort of mining those data sets for red flags that could be promising leads. A couple of other buckets would be tips or complaints and referrals, and those could be from our colleagues, referrals to a potential criminal case from our colleagues at the CFTC, where they've been looking at a matter from a civil perspective and think this is egregious or may have sufficient intent that it rises to the level of criminality that they would bring us in. And another source can be from whistleblowers or market participant victims who will reach out to us directly or our law enforcement partners to report either from a whistleblower sort of insider perspective, misconduct that they are witness and could have an actual direct insider view into, or as a market participant who may have been victimized by conduct in these markets. And I think the investigative tools really build on those leads. Once we've identified potentially criminal conduct, we will then, we have some uniquely criminal tools at our disposal to get at the critical issue in our cases, which is, you mentioned sort of the non-scienter cases. In criminal cases, we always need to have in our world, specific intent to defraud. And so it's a very high level of criminal intent, and we have a very appropriately high burden because of the criminal remedies that are at stake. And so, some of the greatest sources that we have for intent evidence are communications. And, it used to be email. Now I think it's less so email and more chat communications, text messages, ephemeral communications. And how do we get that material? It's largely through search warrants. And so we can do, building probable cause to execute a search warrant on the internet service provider or in a premises or a device in particular to actually get text messages off of subjects and potential targets, phones and other devices. And that's another area where we really work cooperatively with the CFTC to build that lead into what could lead to probable cause to obtain a search warrant and gather additional intent evidence that is actually mutually beneficial for our agency and for our civil enforcement counterparts. So those are just a couple of examples of the kinds of tools that we can use. And another one I'll leave you with is our law enforcement partners at the FBI, other law enforcement agencies, offices of Inspector General that we work with hand in glove in criminal investigations. They also can conduct approaches or interviews of potential subjects and develop cooperators who could really crack open criminal schemes. And so that's another sort of uniquely criminal tool that we have, and we work very closely with our law enforcement agent partners to develop human sources of evidence in the form of cooperating witnesses.
Thanks. Yeah. I guess in that vein, in terms of cooperative enforcement, we call it, you touched on this, but what can you tell us about when DOJ and the CFTC work in parallel together on the same matters?
It's great things happen. I mean, it's for, I think, a number of reasons. From my perspective and our office's perspective as criminal prosecutors, and I've had the pleasure of working really closely with our civil enforcement counterparts at CFTC, in Rob's office, as I mentioned, in Kansas City office in this area here, as well as others. I mean, I think there is a real expertise in the agency and the staff and colleagues that we work with about the products, the nature of the markets, deep and longer relationships with players and market participants at FCMs and end users that I humbly recognize that I have come up to speed and as best I can, but I think having a colleague and resource in the CFTC to say, what do you think of this? What are you seeing here in terms of the facts initially is incredibly helpful to sort of get up to speed on a new product or a new market. And so I think that is an incredibly powerful part of the relationship from our perspective, as well as the in-house I mentioned data, sort of the in-house data expertise and data analytics at the agency as well. And I would like to think, in terms of the mutual benefit, the criminal tools that I just mentioned are things, there are some things that with certain criminal processes we cannot share, namely grand jury material. That's the grand jury is a secret process. So if we obtain materials that reveal the matters occurring or workings of a grand jury, we can't, absent very sort of exceptional circumstances, we can't share that material with our civil counterparts. But search warrant materials, by and large, we can share, and so that's a mutually beneficial process as well. Because if we can develop that additional intent evidence in our parallel case, we can share that with the CFTC, and it can be very beneficial to their parallel civil case as well.
The grand jury stuff is interesting. Just follow up on that. So you may know things that we do not know. Is that challenging when you're working with us and both trying to get at the same thing, but there is just some evidence that you can't tell us about? How is that challenging?
It's a great question, and it can be challenging. I think that fortunately our unit in particular, the fraud section, and our colleagues and counterparts at the CFTC have done a number of very productive parallel enforcement cases, coordinating together. And so I think there are ways where we're very mindful of that issue. I think on both sides are very mindful of that and I think there are ways to mitigate sort of the roadblocks that can create. And just by way of one example, if we are able to coordinate early enough, we will often, the CFTC, in your subpoena authority, you could subpoena materials using your subpoena powers, and then we could submit what's called an access request to the CFTC to receive that material from the CFTC, so that there may be circumstances where we can obtain materials that way, use them appropriately in our criminal investigation, and not have an issue of grand jury secrecy. And so that's just another example. That's one sort of logistical example where early coordination in parallel can actually help to mitigate the roadblocks. But there certainly can be circumstances where there are procedures that we've used and things that we cannot share with our counterparts. We have to, of course, respect those boundaries. And we're, at the end of the day, on sort of parallel tracks and separate agencies with separate sort of equities and remedies and tools at our disposal. But I think we can certainly coordinate very effectively in parallel.
Well, the next thing we were going to do is talk about some cases, some of which are cases that were worked on in parallel, cooperative enforcement actions. So obviously it's a little bit difficult for the government panelists to say much beyond describing the cases that we're going to talk about. These are all closed matters, so there's nothing ongoing that they can't talk about at all. But Eitan, who's been sitting here politely and quietly, is in private practice and has no filters, so he's going to just say whatever comes to mind. Yeah. The first one a lot of you may know about is the Easter Day case, also known as the ghost cattle case, which there was some public debate about. Rob, why don't you tell us about Easter Day?
Sure. And just, with the nature of this panel, cash commodity markets, it's, as an enforcement person at the CFTC, I don't like wake up in the morning thinking, let's dive into the cash markets. Our focus tends to be in the derivatives space. But I think talking about some of these cases sort of at a high level will hopefully illustrate kind of where we get into the cash world and why that's important. And the Easter Day ranches is a pretty good example of that. So this was a fraud case, as Rob said, involving 200,000 ghost cattle. So according to the complaint, Cody Easter Day, for about 10 years, had accumulated over $200 million in losses doing speculative futures trading. And to meet margin calls, he devised a scheme to defraud a large beef producer. But he did that by submitting false invoices and reimbursement requests relating to more than 200,000 cattle that Easter Day ranches had never acquired. And by using the invoices and the reimbursement requests, he was able to obtain $233 million, to which he was not entitled. So the CFTC, we did a case in parallel with Mike's office in Washington, U.S. Attorney's Office. And again, I think one thing, just to build on what Mike was talking about before, was we're a civil enforcement agency and we have some good, strong tools, but there's really nothing like taking away somebody's freedom. And this is an example. I mean, if you want to talk a little bit about how it turned out.
Sure. So, again, working in parallel, our office, brought a criminal case as well. And Mr. Easterday pleaded guilty to wire fraud. He was sentenced to 11 years in prison. Actually, earlier this year, that sentence was reduced to a little over 8 years due to a change in the sentencing guidelines. It's not unique to that case. It's something that's happening in multiple cases around the country due to a change in the guidelines. But very significant sentence for a massive, $250 million fraud scheme. And I think another thing to note about that case is that Easterday pled to wire fraud. And so I think it's an example of, I know there can be sort of jurisdictional issues in terms of the nature of the product or jurisdiction for the CFTC. But from a criminal perspective, the wire fraud statute is a tool that we have in our statutory enforcement violations toolkit. In addition to criminal violations of the CEA, that we also prosecute or attempted commodity price manipulation, which we can talk about in some other case examples. But wire fraud is something that whether it's a ghost cattle scheme or if it were a scheme, hypothetically a scheme involving fraud or manipulation with Vidalia onions, which are not a commodity under the CEA, that could still be wire fraud that our office could come in. And so there's I think, and we deal with this with the SEC as well in terms of what is or isn't a security. It often that can wire fraud can still be, if it rises to the level of criminality and specific intent to defraud and to obtain money and property, which are sort of the essential hallmarks of these statutes. Those broader criminal statutes could be deployed.
And so on the CFTC side, just so you know, it was a fraud case, but we also charged lying to the exchange and a position limit violation. Their exchange position limits. So again, that gets a little bit into, where this sort of intersects the cash commodity part, which is the fraudulent reimbursements, as well as there was the exchange side of things and the position limits to hold the positions.
All right, Eitan, you have been very
I can talk
polite.
now.
You can. This is a case that is, on the one hand, not all that atypical because it's just a huge fraud, and we used our anti-fraud and position limits is nothing new. But on the other hand, it's a unique fact pattern. What's your take on Easter Day?
First of all, it's weird to be able to say whatever I want without a disclaimer and not have to wear a tie, unlike the rest of you guys. The most interesting things about Easter Day to me are the term ghost cattle and who came up with that and how terrifying it is, and Commissioner Stump's dissent.
Yeah.
And to understand Commissioner Stump's dissent, you have to understand a little bit of the history of the CFTC's anti-manipulation and anti-fraud authority. So before Dodd-Frank, before the financial crisis, CFTC for a long time had authority to go after manipulation under 982. Problem was that the CFTC's record in successfully prosecuting 982 cases was spotty because it was really hard. There was this very strict, complicated 4-part test. And now, after Judge Sullivan's opinion, my view, wrong opinion in the DRW case a couple of years ago, it's well nigh impossible for the CFTC to win a 982 case. They still bring them, but they're largely consensual. So after the financial crisis, Congress passed Dodd-Frank, and it included a new anti-fraud, anti-manipulation tool for the CFTC under 6C1, and then later 180.1, the rule was promulgated to kind of build it out. And it was modeled after an SEC, a Securities Act provision, and a SEC Rule 10b-5. So what it did is it said any scheme or artifice to defraud or manipulate. Now, the manipulative or deceptive artifice or scheme. And then the rule used similar language, and it's important to note that the word or was in both of those, right? So fraud or manipulation. And there was some concern expressed at the time that, well, if the CFTC has this kind of blanket authority to go after fraud in any commodity, in any spot commodity, because the statute defines commodity incredibly broadly, what is to prevent the CFTC from just being uber cop on the beat and going after fraud in any market it wants? And the commission issued guidance or commentary on the rules saying, we know this looks like a really broad remit, but we expect to exercise this where it kind of at least touches on our core regulatory authority of futures or price manipulation. And you don't have to worry about us going out and there's some people who expressed the concern that any kind of fraud having to do with the sale of an orange or something like that, not onions or movie tickets, but anything else is a commodity. Commissioner Stump's dissent here says, you're not following that, CFTC. I mean, she didn't dissent from the two charges that Rob just talked about, right? The lying to the CME and the position limits. She said that this, fraud, you don't need to do that. It's not consistent with, what our statement was. And we really, don't have to be and don't need to be and shouldn't be the Uber cop that everybody was afraid of. So that's actually, I think, one of the most interesting questions here is what is the limiting principle for the anti-fraud authority, or the exercise of the anti-fraud authority? Because I think everyone agrees that the CFTC has the authority. The question is, how are you going to exercise that authority? How are you going to pick and choose which cases?
Yeah, and we have encountered the argument that or doesn't really mean or, and that Congress really only wanted to get at manipulation. And we hear these examples like said, made to courts, it can't be that Congress intended the CFTC to have the authority to sue somebody over a single orange or cotton balls at CVS or peanuts. But at some level, you have to be able to trust the agency not to do stupid things with taxpayer dollars, and there's other forms of oversight for that. So yeah, that is an interesting question about where to draw the line. I think the Easterday case probably wasn't on the order of a single orange, but a different fact pattern than we've encountered otherwise. Next, I was going to ask Rob to talk about two cases that have some issues in common, the Kraft case and the Cirrus case.
Yeah, so I'll focus mostly on the Kraft case, but the Kraft was a wheat manipulation matter, and we had some similar issues that came up in oat manipulation case this past fall. But I think, and what ties these two cases together is they involve the delivery market, which is a pretty natural intersection, right, between futures and the cash markets. And just a little backdrop, I mean, typically you're not sourcing, especially if you're milling for human consumption, you're not sourcing your wheat from the futures market, like for a variety of reasons. You can't guarantee the contract, the quality specs, there could be like logistical issues, and just general uncertainty. So if you're loading out, if you're taking delivery and loading out, and you're gonna be milling, for example, it needs to be the most economic source of the wheat. And that, so anytime in any of the markets, it's something that we would look into. So Kraft was a alleged manipulation of the soft red winter wheat futures, and we also alleged manipulation of the cash market prices. And again, in that case, there was allegations of position limit violations, wash sales. And you can see sort of, there's two cases now with position limit violations and in the exchange. It's, again, I think for us, the more things get caught up in our derivatives markets and the exchanges, the more likely we're going to be looking to the cash markets. And so that settled a few years ago for $16 million. And again, like I think, and that it's just another example of sort of a touch point that when we're looking at cases, you know, especially like something like delivery, what kind of positions you're holding into the delivery period, your needs for those, the information you're providing in exchanges about how much you have, how much you need, and how much you're going to process are all things we'd look into it and take us into sort of the cash world, so to speak.
Okay, and did you want to touch on Sirius, or is this kind of covered by the same kind of comment?
It's similar. The allegations were in the oat market. In that one, there was no, it was an attempted manipulation, and there were allegations of attempted manipulation in the cash market. But again, it was another thing where it looked like there was a position being taken in for the delivery period that was concerning.
Yeah, a piece of, wasn't trivial in the case, but a piece of trivia I learned from that case is that the FDA doesn't view the quality of wheat delivered from the particular contract as fit for human consumption because it contains too much of something called vomit toxin.
Yeah, I learned a lot about wheat in that case. And there would be people that would dispute that would say no, that the contract specs are acceptable. But if you're getting into like where you're milling and you're baking and people are eating cookies and crackers and stuff, the specs get more complicated. We could sit here and do like a couple hours on wheat. No.
Well, instead of talking vomitox and Aton, what's your reaction?
The Kraft Mondelez case is a great case for a couple of reasons. I mean, one of them is, you know, the CFTC couldn't use the new anti-fraud, anti-manipulation authority until it was passed with Dodd-Frank, so you could only use it for conduct that happened after Dodd-Frank came into force. So this is one of the first, if not the first case where we used 6C1 180.1. And, you know, in some ways, the Kraft case kind of puts the lie to the false dichotomy between derivatives markets and spot markets, right? Because Kraft has to buy a lot of wheat for the macaroni and cheese, and wheat was more expensive than they wanted. So they manipulated the futures market in order to drive down the price of the spot market for wheat. So there's definitely a relationship between the markets. Kraft was interesting because the district court judge in that case, even though the word or is in both the statute and 180.1, interpreted as and, as conjunctive instead of disjunctive. So the CFTC's position was, look, we only need to prove manipulation. We don't need to prove that Kraft committed fraud. We don't need to prove that there was a lie. And the judge basically said, well, you kind of do. You need to prove that there was some element of deception or fraud there. Then the judge kind of watered it down, saying, look, you sent a false signal to the market by manipulating, so that is a kind of fraud. So it, in practice, isn't that much of a bar, but it is, you know, in my view, a misreading of the statute and the reg. A case that you later litigated on appeal in the Ninth Circuit, the Monix case, actually the Ninth Circuit went the other way and said, or actually means or. So you don't need to have both manipulation and fraud in a 180.1 case. You just need one or the other.
Right. Thanks. Next up, a group of cases that there's a cross-border element in these. Vitol, Glencore, and Freepoint. Rob, why don't you start us off?
Sure. So, and again, I'm just going to talk about these super high level. And again, these are examples in oil and gas markets, but that also frequently implicate the cash markets. Michael talked, like we don't have FCPA, Foreign Corrupt Practices Act jurisdiction, that's the SEC and Department of Justice, but we do have a keen interest where there's a commodity trading component to a foreign corruption scheme. And that's kind of where the cases, so I'm talking Vitol, Glenpoint, and Freepoint, or Glencore and Freepoint. And these, without getting into sort of the specifics of each case, because they're each a little bit different, but there are some general themes. Like for us in this area, there's an area of focus, use of bribes to secure business in connection with regulated activities, manipulation of benchmarks that serve as the basis for related derivatives contracts, reporting prices that are the product of corruption to benchmarks, and corrupt practices that might alter the prices in commodity markets that drive U.S. derivative prices. So again, these cases I think are a pretty good example of where we have sort of strong interest in the cash markets and how that flows over into the derivative markets in our space. And again, these were big cases, you know, 95 million. Glencore was 1.2 billion, and Freepoint, which was this past fall, was 91 million. You want to talk about the DOJ angle?
Absolutely, sure. I mean, I think just to echo that, I mean, so I think these cases show the foreign corruption, bribery as sort of a part of manipulative conduct and the disrupting the markets, as Rob just said. I mean, so the fraud section where I work, we have a unit, the Foreign Corrupt Practices Act unit, that is devoted to these types of cases, and has a mandate to prosecute all FCPA cases brought by the department in partnership with U.S. attorneys' offices all over the country. So we do have a dedicated unit for these kinds of cases. But I agree with Rob. I think that they're interesting because they do show the sort of intersection between foreign bribery and commodity manipulation, benchmark manipulation, and some examples. And so, of these, one in particular, the Glencore case had a simultaneous FCPA resolution as well as a commodity price manipulation plea and resolution with our unit done in partnership with the FCPA. And so, just to give you a sense of sort of the fraud section's focus in this area the last several years, as of last month, so as of March 2024, investigations into commodity trading companies' foreign bribery schemes have resulted in 6 corporate criminal resolutions and the conviction of 20 individuals. And aggregate fines, forfeitures, and other penalties total more than $1.7 billion. And this dates back to investigations since 2017, and where the FCPA unit, partnering with U.S. attorneys' offices, we have our money laundering and asset forfeiture or asset recovery section, and the FBI and law enforcement partners, again in close coordination with the CFTC and other regulators, including in the UK, have been really focusing on these kinds of cases where companies have been paying millions of dollars in bribes to foreign government officials to secure billions of dollars in business with state-owned enterprises. And so, it's been a massive effort and area of focus that's really, I think, again, culminating most recently with the Traffic Euro case, which is an FCPA case just last month, and in Vitoil last month as well. This is a sort of a common theme among these cases.
Yeah. So these are energy cases rather than ag cases, but there's really no reason why you couldn't have who's guilty of that, who's causing the trouble. There's really no reason why that same kinds of fact patterns couldn't appear in the ag space.
For sure.
Yeah,
it's using material non-public information. It's corruption. It's benchmarks like Platts. It's all those different things, and they all similar type of issues could show up certainly in the agricultural markets.
Right. Why don't you tell us about? Well, I guess Eitan, you haven't had an opportunity to comment on this one. Any thoughts to share?
Yeah, I think that, these were cool cases. They were righteous cases, but to advertise them as foreign corruption cases on the CFTC side, I think is a little bit of false advertising. The CFTC Division of Enforcement came out with an advisory in 2019 about foreign corruption. And, as Rob said, there's a statute. It's called the FCPA, and it gives jurisdiction to the SEC and to the Department of Justice to prosecute crimes under the FCPA. In Mike's section, there's a subsection that's devoted entirely to prosecuting FCPA cases. There's about 35 prosecutors there. That's all they do. The SEC has its own section for FCPA. The Glencore case and the Vitol and all the other cases, The misconduct there, the market manipulation would have been criminal whether or not it had any foreign corruption or any bribery involved at all. I mean, it was basically, they were banging the clothes. They were trying to manipulate the Platts benchmark for oil. That's not necessarily related to foreign corruption at all. It just happened to be where they got their information. So, you know, it is great that the CFTC is pursuing these kinds of cases, but to say this is really kind of FCPA or foreign corruption related, it just, you know, the Glencore settlement, they had a settlement with the Department of Justice, they had a settlement with CFTC, they have monitors for both of them. They have separate monitors, right? They have Glencore, the company, has a foreign corruption monitor that reports to DOJ, and they've got a, you know, commodity manipulation monitor that reports to CFTC. So because the CFTC has to deal with commodities and because there's so much foreign corruption in different extraction industries, there's going to be that crossover, and there's going to be cases where both the Department of Justice and the SEC is investigating FCPA violations and the CFTC is investigating manipulation, but that doesn't make them the same thing.
Right, right, kind of a coincidence that there was bribery. Why don't we move on to another non-ag, but not sort of unique to the type of commodity we're talking about, the rust rare coin case. Rob, why don't you tell us about that?
Yeah, and this one's actually an ongoing matter. It was a large Ponzi scheme allegedly perpetrated by a rare coin and precious metals dealer that involved hundreds of victims and losses of about 170 million. And they were soliciting investors for the purported purpose of pooling their money to purchase silver. And in this case, there were no futures or options, but silver is a commodity in interstate commerce. One interesting thing is we don't do all of our cases with Mike. This one was done with the Utah state authorities, and actually under the act, they were able to be co-plaintiffs. And so that's sort of an interesting quirk to this one. But the Galen Rust, the scheme's mastermind, got 19 years, a sentence of 19 years in prison. So like this is, again, there are other examples out there where it's a massive fraud, and it's, you know, something that the commission thinks is important to bring.
Any reaction? Sort of a fairly typical fact pattern.
No reaction. Fraud is bad.
Yeah, fraud is bad. You know, we've had a couple of questions come in. Why don't I take a detour to some of these, and then we can see where we are. One of them is just somebody is curious, has there ever been cases that the CFTC or DOJ have brought involving the cash fertilizer markets? Rob, I'm not aware of any from us.
I can't think of any offhand, but that doesn't mean it hasn't happened.
Yeah, Mike, anything else?
Nor can I, but yeah, not that come to mind.
Got it. Back to craft, and I think actually this may be one that only Eitan can respond to, but the question is there a way to give more transparency to the charges in these cases? Most seem to get settled with the proverbial settle without admitting wrongdoing. It was difficult in the Kraft case and the more recent Anderson's case to see the wrongdoing. As a legit hedger, that makes it hard to self-educate. So what do you think about that transparency question, Rob?
Well, and I can answer. So this is actually, because I tend to agree, like I think it's hard. We run into this mostly with our administrative settlements. And so there's two ways for us to go. There's the administrative settlement, or we file in district court and then have a resolution either through a trial or settlement of that. And it's interesting because especially when you have defense counsel, you get that, this is a complaint we get a lot, that it's like, you know, we want more detail so we can understand. And then as soon as you ask them about their client, they're like, I don't want any details in this order. I want it, you know, as plain vanilla and as basic as possible. The Kraft case we litigated. So you can go on the docket and look at the complaint. You can look at the motion to dismiss, and the motion to dismiss order, the responses. Summary judgment was fully briefed. So there is a ton of information on the Kraft-Mondelez case in the docket. Obviously the settlement's the settlement, but it is an opportunity where there are cases that are litigated in federal court, that there's a lot of information, with evidence and, very detailed explanations of things. So craft is one where I think there actually is the information that's available to the public.
Right. Eitan, you're coming at it from the other side, representing the clients who don't want to be described that way in public documents. What are your thoughts?
Well, first of all, I agree with Rob. There's a ton of detail on craft. The complaint, I think, quotes from internal emails about the scheme. If you're representing a client, you want as milquetoast, brief, and anodyne a statement as possible, and there is some tension there because the commission has long used its orders to kind of send information out to the market about where the red lines are. So there's definitely some tension there. I would say that I don't think the no admit nor deny versus admissions is necessarily a factor in whether or not the commission is able to inform the market about the misconduct. It's just more whether or not there's a feeling that there needs to be that extra level of accountability in making people admit to the misconduct.
Got it. One more from the audience. This is interesting. In what general ways do the CFTC and DOJ view exchange-traded instrument use differently than similar instruments in OTC markets? That's a pretty inside baseball kind of question, but does anybody have a reaction to that?
So my quick response to that is obviously we have a broader playbook with exchange-traded stuff. We also have surveillance folks, and the data is much better from an exchange. When we need to get into the cash markets, it's a lot more difficult to get transactions and records of transactions and things. We can do it, but for those of you that are involved in these, it's tricky. Depends on the market, what's out there. There's some reporting services, but whether or not how accurate it is, and how detailed and what section of the market it reflects can be a challenge. So as far as information, it tends to be easier at least on the data side, certainly, to do any kind of exchange traded stuff versus the cash markets.
Got it. Any other?
I would agree with that. I think that thinking about the tools that I alluded to earlier, created products, as Rob just said, and I think our ability to, whether in-house or in coordination or both, to really analyze those data is easier and can be more efficient in the exchange-traded products. But I think the corollary to that is in cash products and in OTC, there are opportunities for sort of tips, referrals, sort of human source gathering that could be productive as well.
Right. The next question is directed specifically to you, Rob, and it's an interesting issue. How does the CFTC decide whether to bring actions before administrative judges or in federal courts? And there's an easy answer, and then there's kind of a more general philosophical question embedded in there.
Yeah, I'll take the lazy route. Generally, if you're going to settle short of litigation, you're going to go the administrative route. If we think that there's a case to be brought and there's not a resolution short of litigation, then we file in the district courts. I think that's the high level. There's lack of ALJs.
Well, that's important, right? You just touched it. We don't have an ALJ. We don't have an administrative law judge, so that makes the decision easy in individual cases, although we do have the ability, potentially, if we wanted to borrow an administrative law judge. So it doesn't mean we can't do it. And it's not an issue that has gone away for us. There are pluses and minuses to litigating something in-house and then have the commission itself make a decision and apply its expertise that a generalist court just doesn't have. But on the other hand, there is serious constitutional litigation going on and in a series of cases in the Supreme Court, including one pending right now about the legitimacy of that process altogether. So maybe now's not the time.
No, and I'm sure Eitan could say from the defense side, like the benefits or perceived benefits to going the administrative route as opposed to federal court.
I mean, I think that generally prefer not to have a case filed on a docket of federal court if you're a defendant. I thought you were going to ask me to comment on the other side, because when I was director, I thought it was outlandish that the statute allowed us to bring administrative cases, but we didn't have any, and we had, CFTC had ALJs up until what, like 2007 or something, 2008?
11, I think.
That's what I said, 11, and then
Right.
just, got rid of them. And like you said, now is not the time to revisit that until the Supreme Court has kind of ruled on the overall constitutionality of the program.
Right, right. Well, there is a subject that Chuck told me I would be remiss. He's leaving, but bye, Chuck. I was told I would be remiss if I did not mention the Hunt silver manipulation, and that's because it has a local tie. The Hunt family owns and has owned since the founding the Kansas City Chiefs. But it wasn't a Kansas City issue at the time, but 3 Hunt brothers, which this was at the time, and the time being 1979, 1980, they had been one of the richest families in the world, but they had an oil field, a $15 billion oil field, seized by Colonel Muammar Gaddafi. So they found themselves looking for other business ideas, and they determined to acquire 1/3 of the silver supply in the world that was not held by governments, and at huge futures positions as well, and they caused ultimately the price of silver to spike by 700% plus, which led to all kinds of strange behavior out in the real world. This affected the real world. Silver, unlike some precious metals, actually has a lot of industrial uses. So the price spike caused things like doctors being unable to get film for x-rays. And on the other hand, it led to people melting down and selling their family heirloom silverware because it was just too good a deal to pass up. Like most of these things, it ended badly for the Hunt brothers. There was an event called Silver Thursday where the price of silver just simply crashed, and it eventually got back to where it had been. It took a decade, but the CFTC eventually was able to get, I don't remember the exact figures, but 8-figure settlements against each responsible Hunt brother. They ended up in bankruptcy and financial ruin, but as I alluded, all's well that ends well. The Chiefs have won 2 consecutive Super Bowls, so I guess it pays to have connections. I don't know what happened there, Chuck. Maybe you can enlighten us over drinks later. I've got another one come in from the audience. Could you comment on recent enforcements on record-keeping rules and the use of texting, WhatsApp, Teams, chat, and other apps? Emails were a source of information in the Kraft case. So, Rob, why don't you?
Yeah, I mean, there's been a number of matters of offline communications. And if you have an obligation, whether that's through us, through your registration status, to retain business records or certain records, and you are not doing that, you're communicating, or your traders are communicating through, I mean, you name it, like all the different, WhatsApp, Discord. I feel like there's like 3 new ones every day. That's a problem. You're not meeting your obligations, and that's something that we and a number of law enforcement agencies have been looking at pretty seriously, and the penalties are significant.
Yeah, the email evidence in Kraft was, there's one in the complaint that was always amusing to me. The allegation was that they were giving the impression that they were going to take delivery of the wheat, but that was a ruse to goose the price in the cash market. So there was an email that said we are going to quote unquote take delivery of the wheat, and I was at a New Year's party where one of Kraft's lawyers had a little bit to drink and was telling me how worried they were about the quote take delivery email. So people don't write things down. If you're gonna scheme, probably do it verbally.
There was a lot of drama in Kraft. I'm not going to
Yeah.
comment.
CFTC to give.
It's sort of implied, right? Don't do that. Yeah.
I like it when it's written down.
Yeah, no, I mean, it certainly makes it easy, right?
I would add to that. I think, from a criminal perspective, one of the things that if we have cases that are, from a corporate criminal enforcement perspective, when a company, a firm is negotiating a resolution with the department, one of the things that we always look at, consistent with Department of Justice policy, is the state of the company or the firm's compliance program at the time of conduct and at the time of the resolution. And Rob, to your point, I mean, if a company is required to keep communications online and monitor them effectively, those are the kinds of questions that we're going to be looking at. Whether it's for us, it's not from a regulatory requirement perspective, but just from how do you have a functioning dynamic compliance program that can detect this misconduct, and when you detect it, what do you do about it, and are you following red flags effectively? And if all of the if the bad actors in a given scheme were very easily communicating offline and that was going undetected, I mean, that, from my perspective, that would be a concern. And so, if that's what the state of the program hypothetically was at the time of the conduct, what has that firm done lately to remediate that and make sure that it's able to really enforce and bring communications online as part of a sort of surveillance and compliance program. So that's how that can manifest in the sort of corporate criminal enforcement context as well.
And it's one thing if you have like a rogue actor, but what we're finding is you go in and it's, nobody's supposed to use personal devices for business communications, and it's, a whole desk, it's the CEO, it's the CCO, and so the culture of compliance is important, and sort of how widespread the issue is.
Right. Well, I see Chuck looking at his watch, so I guess we'll wrap there. Thank you to those of you who stuck around after the commissioners' panel was over. We maintained a pretty good turnout, and thank you, Chuck, for organizing this. Thank you, panelists.
All righty. Well, thank you, Rob, Eitan, and Mike. I appreciate that panel. I appreciated Rob's ad-libbing how to commit fraud. So that helps make the panel a little more exciting. We're going to take a brief 10-minute break, and then we're going to hear from Ambassador McCaleb. So everyone come back in 10 minutes. Thanks.
So it is an absolute pleasure and honor for me to introduce our next speaker. We're going to do a little bit of a hybrid. So we're going to do prepared remarks, and then I'm going to sit down with Ambassador McCaleb. But Doug McCaleb holds the position of Chief Agriculture Negotiator at the Office of the United States Trade Representative. He was confirmed by the Senate in December of 2022. He has extensive backgrounds, which include Senior Advisor to Secretary Tom Vilsack at USDA with a focus on trade, national security, and health regulations. McCaleb has also held key positions in the Animal and Plant Health Inspection Service, or APHIS, and the Biotechnology Regulatory Services, which is BRS. He has advised on ag and rural affairs at the White House Domestic Policy Council under President Obama and coordinated federal responses to significant agricultural challenges for many, many years. His educational background includes a master's in public policy from American University and a bachelor's in political science from the University of Pittsburgh, alongside leadership and policy studies at the Harvard Kennedy School of Government. And for me personally, and I was just mentioning this to Jim Newsom, but Doug and I have known each other for a number of years. In my previous role before the commission, which goes before 2017 when I was on the Hill working for Senator Stabenow, Ambassador McCaleb and I had a number of interactions on biotech issues, which are still extremely important to the ag community and innovation in the seed space and the crop protection space, and always a difficult set of issues to navigate, I think, from a substantive and a technology perspective, but also from a political perspective. So Doug and I became friends and also developed a lot of policy, which he has seen throughout the USDA. So when we started organizing this conversation and this this meeting, it was a natural fit to have Ambassador McCaleb come and talk about an issue which is obviously extremely important to agriculture, trade, and him being at the front and center of it right now at USTR. I think we'll be able to learn a lot with his prepared remarks, and then he and I, like I said, will sit down and have a couple of questions, but I would encourage all of you to start thinking about questions to jump in because ultimately we want to hear from you. So without further ado, I'm going to introduce Ambassador Doug McCaleb.
Thank you, Chairman Benham. Really appreciate the introduction, and great to see all of you here this afternoon. I'm going to keep my remarks brief for two reasons. One, I understand that I'm the only thing standing in between you all and the cocktail hour. And then secondly, I really wanted to hear what is on your all's mind this afternoon, hopefully respond to some questions and have a good dialogue back and forth. I want to thank CFTC for all that it does, and I'll tell you, having transparency in the marketplace, having rules, having enforcement of rules, having reliability in the trading system is incredibly important. And I see that as I travel the globe and I visit with trading partners in markets where they don't have the kinds of sound apparatus and the kinds of sound enforcement that we do. And I would just want to thank you all for that function and that role. Also, take a moment to thank KSU as well, because I increasingly find myself as an ag negotiator needing and relying upon data that comes from our land grants, from our university system. And that includes data about stewardship and conservation. It includes data about economic analysis, et cetera. All those pieces are incredibly important for us to be successful. USTR has a really unique mission. My position is statutorily mandated to negotiate all agricultural trade deals worldwide. So I was telling Russ just a second ago that, so we're third month into the year, I guess beginning the fourth month. I've been in hotels 40 nights this year on 4 continents, and I think we're up to 28 or 29 airplane trips so far this year. So while that's exciting, the mission is really key, and that is to negotiate the best, most equitable trade arrangements that we can have around the globe to make sure that our farmers, our ranchers are successful and able to export abroad. In terms of where we are right now, so we just came off of a year 2023 where we had about $180 billion of U.S. agricultural exports. The last 3 years in a row have been all-time highs. So we had about $177 billion in 21, almost $200 billion of exports in 2022, and now 180. So there's never been 3 years in a row of the amount of ag exports that U.S. farmers are sending abroad than we have right now. Much of our focus, in addition to trade agreement language, is focused on eliminating regulatory barriers that countries erect that can curb the export of our products to those marketplaces. So we have worked over the course of the last year to reduce tariffs on a dozen different agricultural commodities and to also eliminate barriers to trade in 31 nations over the course of the last year. So that's a big effort. It certainly happens largely in partnership and in concert with our ag and farm commodity organizations as well. There are a few things that are unique to the Biden administration approach on trade, and I wanted to highlight a couple of those for you here this afternoon. And it has to do with how we go about our work, quite frankly, where we go about our work, and which commodities and what products we're working on. Certainly among those commodities that I mentioned a moment ago that we've reduced tariffs on or reduced tariff barriers on, Many of them represent traditional ag commodities such as beef, corn, ethanol for sure. But a large number, and in fact, a vast majority of those 12 commodities that have had tariffs drop this year, many of them were specialty crops, in particular fruits and vegetables, tree nuts, things of that nature, peas and lentils that aren't necessarily on the top headlines of our commodity discussions every day. But certainly this administration has put a lot of time and effort into making sure that the benefits of trade expand to all crops, not just the ones that make up the big exporting numbers, but that we're working with all commodities out there. In addition, I would mention that the types of nations that we're working in might be a little bit different than has been the tradition in the past as well. So certainly a lot of large marketplaces make up many of those wins. India, for example, is a huge source of many of the wins that we had on trade in 2023. In fact, I'll be going there in 2 weeks for a trade mission where we're looking forward to setting up buyers and sellers together based upon those reduced tariffs. Japan is another example where we got the tariff on on-road ethanol reduced. That's another big market too. But we spent a lot of time working with smaller, maybe lesser developed national marketplaces. So just a couple examples. In the nation of Jordan in the Middle East, we were successful at getting tariff reduction on fertilized eggs into Jordan. We've worked a lot on some non-tariff barriers. For example, Bangladesh removed its requirements on fumigation just a few months ago. That's a big deal because that requirement on fumigation was not based upon science. It was really an added cost for no benefit that our companies and exporters were having to go through. Similarly, the nation of South Africa fixed a bunch of labeling requirements on distilled spirits. That's going to have a big impact in that market there as well. And the nation of Korea had been putting up barriers to pet food and animal feed, and we worked very closely with industry to get some corrective action taking place there. So again, I could go on and on. In fact, I love talking about this stuff. There's a long list of nations, but again, the idea is there's no commodity too small, and there's no marketplace that is undeveloped that we definitely are spending time and effort and work in all of those marketplaces to get wins and to get changes in policy that benefit our growers. So over the course of the last 3 years, there have been $21 billion worth of non-tariff barriers that have been removed in the form of regulatory hurdles and other changes to policy that are now benefiting our farmers and our ranchers internationally. Beyond that, the administration is heavily engaged on a few really large trade agreement initiatives. In June, I was part of a signing with the nation of Taiwan, the first phase of an agreement with Taiwan. We're working very strongly to complete an agricultural text this year and to get a trade agreement in place with Taiwan. Similarly, Kenya, in fact, the Kenyans are in Washington, D.C. We just wrapped up negotiations with them this week on a trade text on agriculture. They were actually here during the eclipse, and our team took the ag negotiators out on the ellipse so they could see the eclipse while they were here. But the talks have gone very well. We're very optimistic. We want to wrap up a trade text with them in 2024. Ongoing work in the Pacific Basin. You know, China obviously is a really key market for us for a number of agricultural commodities. But we've been working hard to diversify in that region, to work with 12 nations in the Pacific Basin to get a trade language in place with them. We're going to continue to do that over the course of this year as well. Before I wrap up, I wanted to talk about a few challenges that continue to persist for us on trade. And I'll hit one, which is waterways. The morning the ship hit the bridge in Baltimore, massive response effort went into place from the White House, unified command with the Army Corps, Coast Guard, etc. They've gotten 2 channels opened up, one 11 foot deep on the north side of the wreckage, one is 14 foot deep on the south side of the wreckage. By the end of April, they'll have a 35-foot channel open to one-way traffic. By the end of May, a 50-foot deep channel that will accommodate two-way vessel traffic. So that has been a huge effort. And I'll tell you, I was down in Costa Rica last week, coupling the Baltimore challenges up with where we are with the Panama Canal and the cost of shipping through there with low water levels has been an added challenge. And I won't even get into where we've been in the past year with the Black Sea and the Gulf of Aden as well, with some of the challenges of shipping throughout there. But the administration has put really an all hands on deck approach into all of the above, keeping trade and commerce moving, because it's so vital for the work that we do on agricultural commodities as well. Another challenge from the standpoint of trade balance has to do with U.S. economics right now. And you've probably heard a little bit in the news about the amount of imports coming into the U.S. For agricultural commodities. In fact, they did eclipse our exports last year, which is something in my 30 years working in ag has not been the case. We've normally been a net exporter of agriculture. A few reasons for that. Strong U.S. dollar certainly has made it a lot more attractive for other nations to import into the U.S., and has been a bit of a headwind for agricultural commodities going the other direction with the strong dollar. The good news, if there is one in that, has been that the vast majority of products coming in have tended to be high-valued products like coffee, distilled spirits, tropical fruits and juices, etc., not necessarily ones that the U.S. produces year-round, or that we're necessarily a large producer of those commodities. But that's something that still drives us and motivates us. We want to keep out ahead of that. We certainly want to do everything we can to drive U.S. exports around the globe as well. So with that, I think I'll wrap up again. I was really, really interested in hearing what might be on the chairman's mind, what might be on the minds of the folks in this group. I do, though, want to say that it is a big honor for me to serve as Chief Agriculture Negotiator. It is an honor for me to sit across the table with trading partners and to advocate on behalf of U.S. farmers and ranchers. I believe, as I think all of us in this room believe, that no one produces as high quality agricultural commodities as the U.S. does. No one produces as reliable and as sound from a stewardship perspective as U.S. farmers and ranchers produce. So we just want to give them a level playing field around the globe, make sure that countries aren't erecting barriers and regulation and added costs for us to be pencil out and to be competitive. So thank you for the partnership, and look forward to working very closely with each and every one of you. Thank you.
Thanks, Doug. Again, thanks for being here. And we got 4 good questions right now. Keep feeding them if you'd like, folks. So I'm gonna not focus on my questions for now, but first one, tough one, bird flu. And how have our global trade partners reacted to some of these instances in dairy herds? Yeah. How does that impact trade? I don't want you necessarily to guess at how that might affect cash markets, but what do you see downstream, upstream impacts of that, and how are your negotiations going?
Yeah, one thing I would say, Mr. Chairman, is if you look back, and I was part of the high-path avian influenza response back in 2014, 2015, we did not have regionalization agreements in place at that time, and we saw wholesale, massive, continent-wide in some cases, shutdown of trade take place on poultry products in that outbreak. With where we are today, we've seen a lot less trade disruption based upon the current HPAI situation that we have. So that's been welcome. There have been hurdles. Certainly Colombia, we recently got that resolved, and Colombia has resumed imports of poultry products. Certainly China continues to be a challenge there as well. We're on top of the situation with the movement of high path into cattle. This is something that hadn't been observed previously. Largely it's been in dairy so far. And because of pasteurization, and I think this also is another reminder of why pasteurization is so important, has been a key part of our conversations with trading partners to minimize any backlash on dairy. Certainly, we're going to be heavily engaged as we work with the beef industry, et cetera, on what the next steps are. So, our goal is to make sure science prevails and to keep trading partners from overreacting to a situation. Certainly they pick up the newspaper, they see something on the TV news, and the immediate reaction is to let's cocoon up and let's fight this by defensive posture. But really what it comes down to, I think, is being able to engage with trading partners in a level-headed conversation and to try to, again, make sure that science prevails, that we don't overreact to situations. So yeah, that's really key for us going forward on this.
So on that note, science, going to dovetail to a second question, an issue that you and I dealt with biotech. It is seen, and I assume it continues to be seen as a controversial technology or innovation in the seed space. From a trade perspective, when you have several countries that we have trading relationships with, either fully banning or having skepticism about biotech, how do you deal with those issues? How do you navigate those challenges? And how does it impact the larger trade sort of Venn diagram when you're doing bilaterals or multilateral trade agreement?
Yeah, I mean, I would say that I have seen a change in countries actually moving toward more adoption of biotech. European Union, I would have never guessed 10 years ago or 5 years ago that they would be where they are in terms of having a very developed conversation about gene editing and those types of techniques. Similarly, Kenya has moved to liberalize their biotech approach. We're seeing it in a lot of places. I think there's a few reasons for that. I think sustainability is driving that conversation in a productive manner that it hadn't previously. I think people realize if you want to do conservation tillage on a farm, you want to leave stubble out there, that requires, in many cases, having seeds that are compatible with that practice. It's important to have the types of crop protection chemicals and tools that are compatible with those practices. So that, I think, has really moved the dialogue on biotech in a way that's really beneficial. Situations like Mexico, I think, are somewhat outliers, actually. In some cases, you have a leader that thinks that they can score some political points based upon appealing to the population on something like a GMO issue. And that's why we're heavily engaged in a USMCA case against Mexico right now. We've got a panel in place. Canada has joined the US in that case. We'll get it resolved and get an outcome of the case later in 2024. And that is because we've got to make sure that trading partners focus on science and not politics. At the end of the day, if everyone subscribes to science, it puts all of us in a stronger position to deal with HPAI or an outbreak that those countries may experience. If we're following the science, then we can resume trade in a manner that actually is consistent with what the actual risks are. So we can't have a backslide in places like Mexico and biotech, because quite frankly, if they're given a pass to simply ignore science, that sends a signal to the rest of the world that, okay, we can play politics or do protectionism and pick and choose winners and losers. And that, quite frankly, would be the most detrimental thing we would have to worldwide trade.
So another country close by, Cuba, different relationship, obviously, than Mexico, but where do you see ag exports going, given the history that we've had with Cuba, and where do you see that? I mean, there's huge potential. There's a lot of members in Congress who see this as a huge viable market. What's the reality on the ground from a trade perspective on the likelihood or unlikelihood of a more developed, mature relationship with Cuba and ag exports?
Yeah, I would say certainly a lot of analysis that has been done on that, and there is tremendous opportunities for a variety of U.S. Agricultural commodities in that area, in that region. I would say one thing that the folks in this room can honestly help with is the discussion about trade itself. And you know from Washington, D.C., that it is a very politically charged topic, and there's very strong feelings in various sectors. One of the things I've tried to do as chief ag negotiators when I'm back in the U.S., I visit ports. I went to the port of Oakland. I went to the port of Wilmington. I'm going to be going to the port of Savannah in just a couple weeks. And when I do that, I try to shake hands with longshoremen. I try to shake hands with the Teamsters and the various folks that are electricians and machinists who are all involved in supporting trade in one way or the other. And the reason I do that oftentimes is to help remind the American economy that agriculture trade isn't just about a farmer or a rancher. That's certainly a very important part of it. But there are a lot of hands that touch that ag commodity along the way, that they support their families and their communities, and their first responders and the school system are all supported by those tax dollars that those jobs support. So I feel like as we talk about new markets, and you mentioned one that sometimes can generate a lot of strong feelings, that reminding policymakers and everyone that agriculture trade drives all kinds of jobs in all sectors, I think can help to make those conversations a little bit easier.
Yeah. I'm going to jump in with one quick thought, and this is biased because I'm from Baltimore City, but you mentioned that in your remarks. Any comments? I think it would probably, the audience would benefit with the collapse of the Key Bridge. How is the administration thinking about that? We've seen President Biden very vocally out there working with state and local officials to clear the pathway for barges to move in and out, and then hopefully start the process for rebuilding a bridge. But have you seen any direct impacts in the short term, and do you have any sort of prognosis of any medium or long-term impacts that the bridge is going to have on ag trade?
Yeah, the morning that the dolly hit the bridge and it came down, we were on the phone with advisors and people throughout the agricultural sector all day. I talked to, I think, 10 CEOs that very day just to understand where they stood on supply chains, et cetera. That's indicative of the entire administration. We've had 2, sometimes 3 meetings per day, National Security Council, Department of Transportation, USDA, all hands on deck to make sure that there weren't vulnerabilities that we didn't immediately predict or to understand. Part of our concern has also been, as the port traffic has moved to other places along the East Coast, there's high valued things like automobiles that are at stake and involve fuel, et cetera. Sometimes agricultural commodities, because they may not look as high dollar and high value per volume, when there's shifting that goes on, ag can sometimes get pushed down the priority list. And so we were really sensitive to making sure there were conversations to prevent that, especially where you're dealing with a perishable commodity that can't afford to be sitting on the dock for weeks at a time. So that's been really important. In addition, discussion about fertilizer and other inputs that come in that are needed for processing. There's a lot of fertilizer business that takes place through that particular port. So we're having a lot of conversations there too. But, the president's pledge to get that port open back up and to get, a navigable 35-foot channel available by the end of April is just amazing given the size of that structure and what took place. So, but they're doing it because, again, we got to keep commerce going, lots of jobs, lots of economics at stake by keeping that harbor accessible. And certainly some commodities like sugar are particularly vulnerable there. So we were very much on top of that as well from the onset.
So 2 questions which are related, so I'm going to compress them into one. They both deal with geopolitics and a lot of the issues that are going on across the globe in Asia, the Middle East, and even to an extent Europe, of course. Macro strategy is a word that's being used. So sort of give us the perspective and perception from the administration about how to deal with what I think is a fairly fair conclusion of deglobalization, which is the shift from where we've been for the past couple of days, and how that affects your ability, especially from a trade perspective. And then another phrase that was used in the second question is unipolar to multipolar, and I think it's somewhat related in the fact that we have multiple regions across the globe, different trading relationships, different cultural issues to deal with, but obviously these geopolitical issues overlaying all of it. How do you deal with that? How do you navigate that, given how important it is to the U.S. economy and the ag sector generally?
Mm-hmm. Yeah, I would say from a multilateral perspective that building coalitions on many different topics is a key priority for us. We saw in Abu Dhabi, I was there in February for the WTO ministerial, that there were some threats to trade. There were countries that were proposing rolling back the rules of WTO, providing large-scale exemptions for public stockholding of commodities, even more troubling than just public stockholding, but market price support stockholding, which is really distortive. So, the U.S. in concert with many nations pushed back against that. and prevented there from being a real backsliding at WTO. Beyond that, I would say our approach also involves a lot of bilateral work as well. You know, you look at the traditional model of free trade agreements, which for my 30 years in ag policy, that was sort of the main, you know, vehicle to get things done. There is the reality, though, that you can spend 5, maybe 6 years negotiating a brand new FTA, and then a head of state in one nation or another can pull out of that. And so at the end of the day, the farmer, the rancher doesn't get any benefit. So those 12 tariff reductions that I mentioned earlier, we were able to get those through bilateral discussion of things that were a win-win for the US and a win for those countries that we were working with. And I think that's really important because all of those 12 tariffs have come down this year. It wasn't like we had to wait for 5, 6 years and then wait for a tariff schedule to phase down. Those tariff changes all happened right away. So I think at the end of the day, the farmer just wants to see a difference. Like, what was it before? What was it now? And I think we're really focused on where we can get those wins that don't necessarily pit different sectors against each other. We're not pitting industry against ag on this or ag against textiles over here or what have you, minerals, but working to see what wins agriculture is able to get out there. And I think that's a big difference between what this administration is doing and maybe what people normally think of. And so it's just making sure we explain how that works and that there's a benefit has been really important for us.
So you mentioned this cross-industry challenge, and it's fitting because this question about TikTok, and that's, I think, less an administration issue and more a congressional issue, but that issue has, mushroomed a bit over the past couple of months and even more immediately in the past couple of days or weeks. Putting TikTok aside, but it maybe perhaps is a good example, how do you deal with focusing on ag trade, trying to get to the finish line, lower barriers for trade and exports and imports to an extent, and support the ag producers when you have so many different elements of the larger macro trade conversation having an impact where you have to fear retaliation, right? So in an example like this, and this is the question, especially with a trading partner like China, which has a whole different set of geopolitical dynamics to it, I would assume you have to keep all of these things in mind as you're negotiating, but how much do you let it influence or not the strategy and the negotiations and ultimately like what outcome you're trying to achieve?
Yeah, one of the opportunities I see, and I think everyone in this room is part of this larger conversation, is that food and agriculture can be a bit of a bridge builder in places where there are very tricky geopolitics. And I look at the hot spots around the globe right now. Food is something we can agree should be available. It needs to be available at a low cost, and that should not be used as a weapon or used as a coercion element. So that's, I think, it's something that we can all, again, that we're all involved in agricultural commodities, keep reminding folks that that's something that we all agree we need to get food from one place to the other. We need to put meals on the table, especially in an environment where a global population is continuing to grow where it is. You mentioned China. We had a good bilateral with Minister Tong of China in January. Secretary Vilsack met with him as well. And I think, while we are very much on top of holding China accountable for very state-centered economic policy, that we also at the same time can have very productive discussions about agriculture trade, and I think we have been doing that. And given China's deep economic woes, we've largely kept the trade going, even in the face of policies like Decree 248 from China, which could have stopped ships and not allowed containers and offloading of bulk commodities there. So we think we can do both. I think recently many of you probably heard Secretary Vilsack's commentary that he's looked at sort of the trade numbers for 2023 and soybeans as an example, and there was very much a correlation between trade numbers going down on that commodity and what China's purchases have been. And Secretary Vilsack certainly has pointed out that there's been a lot of discussion about China in Washington that is maybe not very nuanced, and so that's just something for us all to be mindful of, right? Is number one trading partner out there. The discussions on issues like TikTok, on farm ownership, on a whole host of topics. The people are mindful of those conversations, and so again, I think we should keep agriculture as a place to build bridges and not to go the other direction.
So 2 more quick questions, and then off to happy hour here. I get asked this question a fair amount, especially in an election year, but like, how do elections impact your job as a political appointee? And you know, I have my view of it. We have a responsibility as a market regulator, but I think it'd be interesting. And there's a bit of a question that I'm sort of paraphrasing a little bit, but you know, as a trade representative, how does an election year impact your job, and what your short-term and long-term goals are, and potentially even the negotiations themselves?
Yeah, this might not be a sort of a facet of the question that you're anticipating, but I'm actually, and I've been thinking about this a lot lately, very thankful the United States of America has a very well planned out and very good precedent for presidential transitions. And the reason I say that is that I'm dealing with a lot of trading partners around the globe that they're in the midst of elections right now. We got some to our south, we've got some, I'll be visiting one, a larger one in Central Asia coming up. In many cases, my counterparts don't want to talk during those periods of time. They sort of shut down for 4 months or 5 months. And I'm very thankful that I'm part of a system where the professional civil service and that the apparatus of the U.S. government continues to function right up until the point of handoff. And that's the way it should be. That's the way I certainly hope it will continue to be in our country. But it really doesn't affect me as much as you would think. You've known me a long time, and I always have an urgency in whatever job I'm in to get stuff done. So certainly while I look ahead to the fall and to, you know, I'll come up on my 2nd anniversary in this job in January, I feel an urgency to get things done irrespective of what might be happening on the election calendar. But I am certainly very thankful that we continue to do business and the U.S. government doesn't tend to seize up and to get all bureaucratic because of an uncertainty over elections.
Yeah, that's well said. So you got last question. You got confirmed in December of 2022, which is what I mentioned in your open in my introduction. Yeah. You get into this job. You've been around agriculture for decades at this point. You've been at the apex of ag policy, arguably being around the secretary for multiple years, and in different roles within USDA. You sit down in this job. How much of a transition was it for you to really focus on the trade component of agriculture as opposed to all of the other responsibilities you've had at USDA over the years? And when you step into that role, and you were the first trade rep for ag in the Biden administration, obviously a year or so plus, almost 2 actually, after the transition, you sit into that chair. What were your goals? What were your immediate concerns, and how did you view what had been done before you? And we were talking about your predecessor, Greg Dowd, who's spoken at this conference a few years ago, and who was also a great representative for agriculture. What was like the top 3 list for Ambassador McCaleb to sit down in that chair? Yeah, I mean, certainly looking at the big numbers, I certainly want to expand exports in every nation. We have, I call it the merit badges on the Scout thing, that I wanted to cover that whole sash with merit badges of places where we do a Japan beef tariff reduction, where we get tariff reduction on fertilized eggs into Jordan, and a long list of those types of things. Also, to really expand the biofuel market was a big goal, and to not allow countries to backslide on their existing trade agreements. I saw Greg the other night, and I was telling him and a large group of CEOs that any promise that nations made Ambassador Dowd, I consider to be a promise made to me. And that gets back to the continuity thing too, where a trading partner knows that they can't tell one chief ag negotiator one thing, and well, he may be gone in a few months and then we won't hear about it again. I consider everything that they promised him to be a promise to me too. So keeping that continuity, and I'll tell you something I really appreciated coming into this role is the unity among American agriculture. Take the Mexico biotech corn case. I've been standing in fields of almond trees in California and had the farmer come up to me and say, "We appreciate what you're doing on that Mexico biotech case. We don't have a game, you know, that's not a thing for us, but
if they backslide on there, they're going to backslide on phylloxera. They're going to backslide on some other scientific issue. And I think American agriculture does a heck of a good job of farmers being united, whether you're in dairy or whether you're in cotton or what have you, that everyone kind of looks out for each other's back. And if a trading partner slips and slides on an existing agreement, we're all there for one another. And I think that puts me in a stronger position to do my job. Ambassador Tai certainly appreciates the strong agricultural voices, Secretary Vilsack too. So that's an asset that I really found coming into the job. It was a tremendous asset for all of us.
Yeah, I mean, I think it actually makes my job easy too. Agriculture transcends politics in many respects, not all respects, but in many respects. I think it is the reason we have successful farm bills, and we're going to be hopeful for another comprehensive farm bill this year or soon. And you know, it's all of you being here, advocating, talking to us about what you need in order to do your job and provide food and fiber to Americans. So, Ambassador, you said how lucky and privileged you are to have the job, and I think it goes without saying that we are all lucky to have you in this role, being the #1 diplomat for trade in agriculture for the United States. You have exhaustive and extensive experience, which has served us well and has served you well, and we look forward to your continued success. And thank you, above all else, for coming to Kansas City. So please welcome me, or join me in giving Doug a round of applause.
Thanks, I really appreciate it. Yeah, good.
All right, thank you so much, Ambassador McCaleb, for the terrific comments. Really quick, as everyone knows, drinks and a cash bar are outside, so please join us. And breakfast will be available tomorrow morning, start at 7, and opening remarks from Senator Marshall are tomorrow at 8. So everyone have a good night, and thanks for a terrific day one. Appreciate it.